150th anniversary.
John, I'm beating you to death.
In 25 years on Bloomberg TV and radio, the next time
Futures
I'll quote the Dow. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Secretary of State Antony Blinken is in Egypt on the next leg of a diplomatic mission aimed at shoring up a ceasefire between Israel and Hamas. He'll meet with top officials, including Egypt's president. Blinken has vowed to rally international support to rebuild Gaza, whilst also promising to make sure that none of the aid destined for the territory reaches Hamas. Canadian Prime Minister Justin Trudeau is beginning to sketch out a plan to reopen the U.S. border, but Canadians don't appear keen to rush it. And when travel does resume, they overwhelmingly agree proof of vaccination should be mandatory. Nearly half of respondents in an Angus Reid Institute poll released today said the border should remain closed until at least September. In India, more than 2 million people have fled their homes as a powerful cyclone hammers the east coast. The cyclone is packing winds of up to 96 miles per hour and may push sea levels 10 feet above regular levels. It's the second severe storm to batter India in 10 days and comes as the country battles the world's worst outbreak of COVID-19.
Hello, traders. Time to sell short euro. I'm going to place order to sell short euro at 122.42. Okay, and order failed, so you still have time. You can buy at any price right now euro. So it's, if you're already in, stay with me. We just fill the order for euro. 1 pip equals, in our case, 100 pounds. In your case, it's all about how much you decided to invest to trade this pair. Okay? I'll speak to you later, guys.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Place stop on profit for euro. at 122.40. It's called fast money trade. Yeah, we're already in profit, as you can see. All of you guys who follow trade, who decided to copy this trade, as you can see, it's free. You don't have to pay anything at all. You just need to know. You don't have to be amateur. You have to be. You have to have some kind of experience. You have to know how much you want to invest, all these things, and you're already in profit. If you don't know what we're doing, you need to get the strategy. It's available on our website, companyeye.co.uk. So you need to go to companyeye.co.uk and get the strategy. Okay, I'll speak to you later.
Israelis and Palestinians that will take down tension.
Antony Blinken there, the US Secretary of State from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equity futures up a third of 1% this Wednesday morning on the S&P 500, advancing about 11 points. Elsewhere into the bond market, yields are higher by about half a basis point to 156.38 after the Treasury market just shrugged in a subtle evolution of the language of Vice Chair Clarida, teeing up talking about tapering maybe, Tom, in the next couple of meetings. As Lisa pointed out, a load of hedges around that, but still, to see yields lower on the day when that interview took place with Yahoo Finance, I think was quite remarkable.
One of the great services we have here at Surveillance is not only to look at the economics, finance, investment of the moment, but also to translate the King's English. John, what in God's name does crackers mean?
Crackers, replace crackers with nuts. Does that make more sense now? Do you want me to give you the full sentence
crackers
so
are nuts. I just
the
looked it up and
audience
it's
understands
Elizabethan English.
what we're talking about?
Crackers.
The former advisor to the Prime Minister, Mr. Dominic Cummings, in a hearing today saying it's crackers, call it nuts, that Prime Minister Johnson became Prime Minister, Tom, went on to say that the system has gone wrong if the choice is Johnson or Corbyn, and that was the choice a couple of Decembers ago in the last election in the UK. Tom, not surprising that this is the tone, the comments that the former advisor to the Prime Minister is making. I think we've all been prepared for this one.
Very good. Well, we see that, folks. Your Elizabethan lesson for the day. Crackers moving from loud braggarts of the northern realm over to nuts. We digress to the crackers of Washington. Emily Wilkins joins us, Bloomberg Crackers correspondent in Washington. Emily, I want to get away from the news flow today to a leading story by Matthew Bessler and Craig Torres of Bloomberg as they look at where this Federal Reserve is heading. It's May. We get through the summer. We move on to next year, and it may be a new Fed. How will the president shape the Federal Reserve?
So at this point, President Biden's stance toward the Federal Reserve has to try to be as hands-off as he possibly can with it. You know, he hasn't spoken with a lot of members. He's tried not to influence them. This is supposed to sort of be a giant shift from what we saw with former President Trump, who was very open about criticizing the Federal Reserve and the chairs of it. And so at this point, it's a little unclear exactly how President Biden is going to go forward, but we know that he has pressure from within his own party. Yesterday, we saw Senator Elizabeth Warren really slam one of the vice chairs, Randall Quarles, in a hearing, saying that he was not living up to the oversight that was needed on some of the federal institutions, including, I think, Credit Suisse.
This really is the myth of independence of a central bank in many ways, Tom, because the Federal Reserve Chair has not spoken to the president because this administration is very wary about treading on the independence of the Federal Reserve. Yet, listen to the conversation we're about to have. The administration wants to select its own people for the Federal Reserve. Now, I have no issue with that, had no issue with the previous administration nominating who they wanted to run the Federal Reserve, but it's almost the myth of independence, isn't it? If you're recasting what the Federal Reserve is going to look like, dovish, hawkish, whatever, you're doing that for your own personal gain, your own administration's goals.
But, John, a massive asterisk here is they're resetting after the unique Federal Reserve tone of the Trump administration. Emily Wilkins, I believe there's an advisor to the president here, Yellen of Brooklyn. What's Secretary Yellen going to tell him about the next chair and the next vice chairman of monetary policy?
I mean, look, Secretary Yellen is sort of in this really unique role where she has held all of these different positions within the federal government has this really unique insight to the role and to what is needed. I think we would expect to a certain extent, she is in Biden's cabinet, we would expect the two of them to speak with each other. I think a lot of it's going to be coming at what we're going to see the economy do as we continue this recovery. Are we going to continue to see high inflation numbers? Are we going to continue to see unemployment really not come back with what we were initially expecting? And so I think there are lots of other metrics to consider here, a lot of questions about what the economy is going to look like and what the Fed's role in stimulating it needs to be.
Meantime, Senator Warren's comments to Randy Quarles, Vice Chair of Supervision for the Federal Reserve, really highlights a perhaps divide in terms of Congress members when it comes to big banks, and this comes ahead of the hearings that start today in front of the Senate. Just to reiterate the quote that John was talking about earlier, Senator Warren saying, "Our financial system will be safer when you are gone." This is to Randy Quarles. "I urge President Biden to fill your role with someone who will actually keep our financial system safe." Is the argument here that the financial system has not been safe?
I mean, Senator Warren has always sort of been very diligent, perhaps is the word, or very aggressive, it could be another word, when it comes to the financial markets, making sure that consumers are being protected. And she has, sort of called out this one instance as a concern for hers. But this has sort of been her role as sort of a big watchdog of the financial institutions. I would say that, her views aren't necessarily shared by everyone within the Democratic Party. She's certainly a strong and outspoken voice. And I'm sure there are many people besides Senator Warren who kind of have thoughts here about how the Biden administration can best proceed, what they would like to see coming up from the Federal Reserve in the next bit. So I think this is certainly, Senator Warren is a loud voice, but she is also not the only voice.
Emily, thank you. Got to leave it there. Emily Wilkins there of Bloomberg Government. The numbers don't help the banks, do they, Lisa? You're not allowed to make money in a downturn. Record profits at Wall Street's biggest banks. And you know where they'll point? It's going to be interesting.
Well, at the same time, they can point to the fact that they've been a bastion of stability through this whole issue, right? I mean, that they haven't been perhaps at risk of any sort of insolvency whatsoever, even with some pretty big missteps. I'm thinking of Archegos and Greensill, among others. But I'm just looking at this and thinking, okay, yes, they have record profits. But on the financial stability side, do you really see an argument on that front?
Look, I'm with you, but isn't this about optics? That's what it's always about. It's not about substance, it's about the politics and the optics and what to sound to the electorate. You know how this works. You take the video, you clip it, you put it on YouTube, and you send it out to constituents. That's how this always works, and once again, that's what this is going to be.
Although I do wonder how much the emphasis is going to be on lending, right? I mean, that's really the question. Why are they not lending to more people? And couldn't the bank CEOs simply say, well it's not profitable for us, Tom?
I hate to get back to the microeconomics of a moment and spoil the conversation, but that's the heart of the matter, John. The demand isn't there.
TK, exactly. We got $5 trillion or something over the last year in money market funds.
Yeah, well, you see it. Do you have that chart right now? I don't know, Riley, if you can get this chart up. John, Lisa mentioned this earlier. It's all over. Zero Hedge has done it up bigger. And it's just the amount of cash, John, parked. It is unreal. The little on radio, there's a spike up and there's a circle, which was like 5 days ago. And now we've exploded up to near record cash parked, John, because they don't know what to do with it.
Yeah, and this goes into the reverse repo operations that the Fed has been offering, that you saw the biggest take up by the banks since 2016, John. Banks are searching for a way to put that cash somewhere where they can get any modicum of income.
It's a serious issue, but this afternoon, likely to be a bit of a soap opera. Surprised me. I look forward to being surprised. Coming up, Lindsay Piegza, Stifel, Chief Economist from New York City for our audience worldwide, alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Equity futures 41.96 on the S&P. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
6:30 in New York for our audience worldwide. Good morning to you. Here's the price action this Wednesday morning. We advance about 12 points on the S&P, just short of 4,200. On the Nasdaq, up by about 0.25% on the Russell, up by about a half. Some outperformance on the small caps again today. That's the story of the equity market. Switch on the board into the bond market. 2s, 10s and 30s. Your yields look like this. 156.38 on a 10-year. A shrug of the shoulders in the face of Vice Chair Clarida's comments on Yahoo Finance just yesterday, teeing up the prospect of talking about tapering, and you're so bored by that right now that seemingly it did nothing to this market. Yields were lower on the session yesterday. That's the story on this side of the Atlantic. On the other side of the Atlantic, look out Germany, another soft bond auction, this time on a 15-year maturity. Let's finish on euro-dollar. Fabio Panetta of the ECB out again this morning, speaking to Nikkei, I believe. Tom, just briefly, euro-dollar 122.37, pushing back against the idea of scaling back the asset purchase program. That seems to be the view of Fabio Panetta over at the ECB. And I imagine, Tom, on June 10th, you might get just a little bit more of that from President Lagarde. Your euro weaker by 1/10 of 1%.
Yeah, but I'm glad you showed the bonds. I mean, I think, folks, there's a real shift here on a Wednesday. But, John, I would go back again to the 125th birthday of the Dow Jones Industrial Average. The Wall Street Journal writing up a beautiful treatment on the scope and scale of the Dow. And, John, this is my parents' heritage. They were Depression babies, as there were a lot of Depression babies. The Dow didn't hit a new high off 1929 until 1953.
That's quite a stat. That is quite a stat.
We have no modern analog to that.
Do you quote the temperature in Fahrenheit still? You do, don't you?
We do quote it in Fahrenheit here in America.
It's kind of meaningless to the people who know what they're talking about.
It is, but you know, there it is.
Whoa, that is a low blow.
Just, you know, just getting that one in there.
Really? Wow.
We can wrap it up. We can wrap it up.
Please.
The generational span.
My favorite quote about the Dow is it's like quoting the scores of a game no one plays anymore. That's my view of the Dow. But that's it, whatever that's worth. Happy birthday to the Dow Jones Industrial Average.
Yeah.
Thank you. 125 years, that's great.
At 34,000, which I never frankly thought we would frame to see. We welcome all of you worldwide on radio and television. John Farrell, Lisa Bramwitz, and Tom Keene. And, you know, I look, Lisa, at where we are, the stew of an end of May. And Lisa, to me, the stew of the end of the May is we're resetting what growth will be later this year. No one knows, but I would say, Lisa, we're getting away from the gloom that was there 6 weeks ago.
Yeah, look, things are not looking gloomy, but people are talking about a deceleration in growth. I want to point out one metric that came out yesterday that really went under the radar, and that is the M2 money supply. That basically you've seen a big deceleration in the creation of cash, and you see an increasing number of analysts wondering if this perhaps is what's creating some of the wobbles that you're seeing in risk markets. The idea that we're not creating money in the system as quickly as we were over the past 12 months.
I have trouble with M2 analysis. I really do. I think that there's been a lot of good research, John, on this. It doesn't push it aside, but it doesn't have the focus that it had when the Dow was at 10,000.
Thank you, Tom. My value add here, there hasn't been a strong enough correlation between money supply and inflation.
Yeah.
And that's why so many economists recently have pushed back against looking at that almost exclusively as a read on what's about to happen with price pressure.
That's fair.
Yeah, I would go with that. But, you know, I do think the voguishness, I don't know what the vogue is right now, John, but I am certain the vogue is very few people are on board with Steve Major of lower interest rates like we've seen in the last 10 days.
Yields are lower, Tom, and they have been over the last 24 hours. This morning, they're higher by about a basis point, about 156, 157 on 10s.
Lindsay Piegza joins us now, Stifel, their chief economist. And Lindsay, we're talking here about the Fed shift and the ambiguities that are out there. Lindsay, is it just a certitude that we get inflation, or can you give us a different spin from that?
Oh, I think we already have inflation. I think it's very clear that there are very widespread price pressures in the economy at this point, with the PPI up over 6%, the CPI up over 4%. And I think the realization that price pressures are well above expectations is why we're hearing from Fed officials so frequently reiterating the message that inflation is going to prove transitory.
Then why are yields in?
Well, I think right now the market is buying the Fed's message of inflation dismissal. We heard from a number of Fed presidents yesterday, and this message that inflation is going to be temporary, it is going to prove transitory by the end of the year. And the more that Fed officials jawbone the market, the more we're going to see this more positive reaction in terms of downward pressure on yields.
Do you think in many ways, Lindsay, the Fed and the market's been on the same page, despite the kind of conversations we'd have on this program?
I do think so. I think there's a lot of concern out there in terms of the longer run inflationary implications, particularly as we see this insatiable appetite for further government spending. But in the near term, the market does seem to be in lockstep with the Fed, really buying, again, this notion that inflation is just a reflection of base effects, just a reflection of a temporary recalibration as a stimulus-fueled consumer puts temporary pressure on producers, but eventually that evens out and we find a new post-pandemic equilibrium.
Lindsay, things are changing elsewhere. We had New Zealand joining Canada, starting to push back against loose monetary policy forever. Do you think the Fed could get left behind here by other central banks around the world?
I think, if anything, the Fed is pushing the opposite direction, meaning perpetual accommodative policy. Remember, the Fed has adjusted their framework and how they approach meeting the dual mandate of stable prices, full employment. From an employment standpoint, they're now going to look at it from a more diversified perspective, meaning that even if the national unemployment rate comes down into the Fed's range of full employment, if a group of the labor force is left behind, be that the black unemployment rate or the female unemployment rate, the Fed's going to err on the side of caution, keeping rates lower for longer to give that group that's left behind additional time to catch up with the rest of the country. And on the inflation side, the Fed is now targeting an average of 2% inflation. So this really gives the Fed a lot of leeway to let inflation run hot without feeling the pressure to adjust policy. So this new framework really opens up the runway, gives the Fed an incredible amount of wiggle room to keep rates much lower than they would have otherwise historically under the old framework.
Lindsay, is inflation good or bad?
Well, I suppose it depends on how much inflation. Remember, the Fed thinks that a certain amount, a minimal amount of inflation, is a positive indication that the economy is growing. But if we get too much inflation, this can undermine the investment and the savings of the country and spike us into this hyperinflation cycle. So is inflation good? A little bit of inflation is good, but too much can be very detrimental to the longer-term prospects of the country.
Which raises a question, Lindsay, about what is too much. And I'm thinking, for example, of the U.S. Consumer Confidence Survey that came out yesterday that showed a decline that was bigger than expected on inflation expectations, the fact that people expect their money not to go as far going forward. We're seeing this increasingly. At what point do higher inflation expectations dampen economic growth just at a time when the Fed doesn't want to see that?
Right. I think the comfortable range would be a sustained level of about 3%, or I should say the uncomfortable range would be a sustained level at 3%. The Fed, however, has really widened that range to suggest that they would be comfortable with an above 3% pace for an extended period of time. Because remember, as I mentioned just a second ago, they're targeting an average of 2%. So with inflation right now averaging 1.3% since 2015, they could easily let inflation run above 3% for the next 5 years and still not exceed their longer run average of 2%.
Okay, so Lindsay, too much inflation is detrimental, but there's a part that's good. Okay, it's the bright lights of inflation. What's the appropriate run rate for this economy? What's the appropriate nominal GDP?
I think the long-term potential for this country is 1.8%. So wow. I do think that when we start to remove the punch bowl that has really has been the primary support for the 2021 growth profile, I do see the economy slowing to closer to a 2-3% rate next year, and then slowing further in the longer term, somewhere around 1.8 to 2%, 1% from productivity growth, 1% from population growth. That's really the bare minimum that we should expect, but it is what I anticipate in terms of longer run forecast.
Lindsay, thank you. We've got to leave it there. Lindsay Piegza there, Stifel, chief economist. And that right there, Tom, and forgive the cliche, is why so many people say they want to rent value, cyclicals, and they want to own growth still. Yeah. Because this cycle, this transition back to trend growth of south of 2%, say, it's going to take you back to those old names being big tech.
Yeah, well, John, I think you're dead on, and I think it's a concept that's been there the last couple of days, this idea of what do you want to rent, what do you want to own. You hear that from Doug Cass in his veneration of the Dow Jones Industrial Average, and you wonder within the Dow or even the younger Standard & Poor's Index, John, where's the growth and where's the value, and that's the great partition.
Are you the down on the S&P? Is that what you were going with just
No,
then?
I'm not going with that. I think the S&P is great. It's just we visualize our culture off of the Dow at 34,000. We frame that back to our Ute.
Okay.
Back to American Cotton Oil and, the National Distillery and the other stocks that Grandpa owned.
And we'll continue this argument through today and through the next decade, I'm sure. Lisa, I'm catching up with Dan Suzuki of RB Advice just a little bit later. And he is really pushing this idea over at that firm that you should stay with the cyclicals through the cycle, that things have changed. That reluctance, though, is still out there, largely because of what Lindsay just described, this return to 2.
Yeah, well, and actually I was looking this morning at the month-to-date returns for the Russell 2000, and it's actually the biggest loss since September of last year, and it's underperforming a number of other metrics. The S&P is actually up on the month. So just to give you a sense of how people have been rotating out of some of those cyclicals, the question is it too early, or have we already gotten to peak growth, and are we looking now at a deceleration in the near term?
It's getting quite heated out there. We Americans might use Fahrenheit, but you guys still use stones for weight. Yeah. Plus, there's that whole separate hot and cold water spigots thing. What have I started this morning?
Look what you started. Can I do a quick shout out?
I just want to say,
Karen Langley and Peter Santilli. I'm stealing all this, folks, from the Wall Street Journal. It's frankly that the Journal's doing the articles great with their heritage with the Dow. But to Karen Langley and Peter Santilli, I'm stealing everything this morning as much as I can.
Coming up, Lawrence Sauer, Johns Hopkins Associate Professor of Emergency Medicine from New York City.
Copper, 123 7/8.
Equity futures up a third of 1% on the S&P 500, 41.96. Your bond market 156.55. That's your yield on a 10-year. Alongside Tom Keene, Lisa Brandwitz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Billionaire investor Carl Icahn says crypto may be here to stay, but he hasn't bought any. In an interview with Bloomberg News, Icahn also said President Biden must be careful not to overstimulate the U.S. economy. And he said inflation, quote, already exists, and that will cause a correction. We'll hear more from Icahn at 2:10 p.m. Wall Street time today, live on Bloomberg Television and Radio. The UK is backtracking over its attempt to restrict travel to coronavirus hotspots in England. The U-turn came after ministers were accused of introducing what some called, quote, local lockdowns by the back door. That triggered backlash from members of parliament over the unclear guidance, which led to the cancellation of public events and some people halting planned vacations. Police in northern Italy have arrested 3 people in connection with Sunday's cable car accident that left 14 people dead. Officials say a clamp that was placed on the emergency brake several weeks ago as a temporary repair was never removed. That prevented the brake from working when the lead cable snapped. The lone survivor of the crash, a 5-year-old boy, remains hospitalized. A Chinese startup that connects restaurants with vegetable producers has confidentially filed for an IPO offering in the U.S. Bloomberg has learned Meiji is working with banks, including Bank of America, China Renaissance Holdings, and Morgan Stanley. In February, Bloomberg News reported that Meiji had previously considered raising about $300 million until the sudden departure of its chief financial officer. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Riska Gupta. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think it would be very difficult to see this virus be able to spiral out of control and threaten hospitals again, because the virus doesn't treat people equally, and we have vaccinated really aggressively in those groups of people that constituted the majority of people who were being hospitalized. So to me, I think we've removed that ability from the virus. We've made it much more like other respiratory viruses that we deal with year in and year out.
It's time to move on. That seems to be the message coming from Emma Shadauja there, the Johns Hopkins Center for Health Security Senior Scholar from New York City this morning. Good morning. Alongside Tom Keene, Lisa Brambitz, I'm Jonathan Ferro. Wednesday morning and your Wednesday morning price action looks like this on the S&P 500, advancing 11 points. We are higher by 0.25%. NASDAQ 100 futures up nicely, up 0.25%, advancing 34, call it 35 points higher. In the bond market, yields not doing much, 156.55, getting comfortable south of 160. And a euro slightly negative, just a little bit of pushback against removing accommodation from the ECB's Fabio Panetta this morning. Euro dollar Tom 122.37.
Really, as soon as you features again, I would go to the lower yield as being profound over the last few days. America's opening up. I can look at the tots and its capacity of 63,000 at a stadium. They can't put that many seats in there because the team sucks. Separate from that is maybe venerable Wrigley Field in Chicago, where the Chicago Cubs are going to move to 60% capacity off of almost 42,000 seats. Lauren Sauer joins at Johns Hopkins in emergency medicine. Lauren, it's become a real theme of this show, which is how do the unvaccinated bounce off in opening America? At Wrigley Field, do you put them in section 503 to section 538 up in the middle of nowhere? What do we do with the unvaccinated at sports events?
I think the biggest thing we have to do is make vaccine available, right? So maybe we have off-event vaccine access at those sites so that we can encourage them to get vaccinated. I mean, I think the outdoor events are going to be places where you're going to see a lot of commingling of vaccinated and unvaccinated people. But the place we are in America right now is that vaccinated and unvaccinated are going to be together, and they're, in many cases, they're going to be maskless. It is an honor system the way we have it set up now. An honor system?
What is it? Come on, I don't mean to interrupt, Lauren, but you've hit the third rail. An honor system? We didn't do that with typhoid. We didn't do that with tetanus. We didn't do that with diphtheria. Where do we come up with pros like you with an honor system?
Yeah, I mean, I don't think that there's a way around it the way it's been set up. I don't think it's a good system, to be perfectly frank. I think I'm nervous about being out in public as an individual where so many people in certain places aren't vaccinated, and we don't have a way of enforcing vaccination. We don't have a way of even documenting vaccination in a meaningful way, and our disparate rules and regulations around who can do what is going to create spaces where people may not be as comfortable being in them, and you're going to have places where people are mixing vaccinated and unvaccinated no matter what.
But Lauren, can you elaborate a little bit on not feeling safe because there are potentially so many people who are unvaccinated and not wearing masks? What are you worried about as a vaccinated individual?
So me personally, I'm worried about getting a low-grade infection, like a breakthrough infection in vaccination, and then spreading it to people that I'm close with who are at higher risk, or people who I come into contact who are at higher risk. I'll continue to wear my mask until I feel like there is a space where we can do that safely, where the vaccination rates are much higher. And in some areas, they are very high. But across the U.S., I think we have a patchwork of high and low vaccination rates. And that's the space we have to work in. So I'm not worried about myself getting very sick. I think the vaccines show us that is not happening. And I think for the most part, we're seeing that the vaccinations prevent infection transmission, but there are these cases that potentially allow me as a vaccinated individual to spread COVID. So and I think it's worth the mild inconvenience of wearing that mask to take an extra step to prevent that.
Lauren, Tom was talking about the honor system and the third rail and talking about how this wasn't the case for diphtheria and typhoid. And I think about the MMR vaccines, the whole vaccination role that we have to give schools to allow our children to go to them. At what point is this going to be put on that list, especially if we want to get kids back in the classroom this September?
I think we're probably really close to seeing that happen. I mean, the space where we are right now is that we have several emergency use authorization vaccines. And I think as we move those vaccines into approval, we will see many more places feeling comfortable adding them to the required vaccination list. You're still going to have individuals and families and groups of people who have exemptions, and you'll have to manage those exemptions, but making them mandatory in spaces is going to remove a lot of people who are on the fence because it is required. So they will get the vaccine because it is required. And so any moves that happen towards approval versus the current status of emergency use authorization will make that path smoother and shorter.
Okay, Lauren, to cut to the chase here, I mean, you know, we're only asking these questions for Lisa. She's slotted in Padres Mets, June 12th. She likes to sit just off the third base dugout, just to the left of where Keith Olbermann sits. Okay, Lisa needs to go to that game with her offspring. Should she go? Will they be safe?
Thanks, Tom.
I think I think that an outdoor event like that is a great option for safe and fun activities that you can do with kids. And I think, you know, if when you get there, you feel like it's a little too crowded for your liking, and you're, you know, especially if your kids are younger and haven't been vaccinated yet, you know, put that mask on. And that creates just that little extra barrier that we are starting to see evidence that shows that it does work. And I think it is a space where we can take one extra step that'll make us feel a little safer. But a large open outdoor event, especially if they're still doing distance seating, is a really good option.
Is it about making us safer or making us feel safer, Lauren? Which one?
I think it's a mix. I think the masks are just an extra step that allow us to have a slightly higher level of protection. I think if it makes you feel safer, then it probably makes you behave safer, and then that's a you know, a benefit in the right direction. And I think if you're wearing a mask might not make you safer, but does potentially make someone that you come into contact with later safer because of this, you know, sort of stopping of the transmission chain for people who've been vaccinated but have really low levels of disease, then it's a mild inconvenience. And so I think it's always going to be a mix of both. And a lot of our public health activities are a mix of being safer, creating a safer environment, and making people feel safer. And that combination is always going to be there, and it's always going to be important.
Nobody is safe when Lisa's at the game. That's the truth of it.
Thank you.
Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine.
For the kids.
Lisa after a drink, Tom, at the ball game.
Yeah, but that's indoors, so she goes to the kids. She'll be outdoors the whole time.
That's me.
Coming up,
pushing people out of the way.
Steve Cheverone of Federated.
Narragansett
from New York, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro.
More Dow trivia coming up.
41.97 on the S&P. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Is not necessarily 100% comfortable with the Fed's ability to do everything that it says.
We've already had a bit of a melt-up in the first half of the year, so we don't necessarily see another melt-up happening.
The idea of transitory is a debate we will be having consistently until October.
Even if we get some decent CPI prints for the next several months, I don't think that's going to be enough to force the Fed's hand into tightening any time before 2024.
You cannot really push the story of average inflation targeting and then have a rate hike as soon as 2022.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up 12 on the S&P, advancing 1/3 is what is not happening in the bond market that gets your attention. Yields are not rising, they're falling over the last 24 hours. Up a little bit today, but your 10-year, Tom, 156.
Yeah, Monday was sort of a snooze fest. We covered that yesterday, but I'm sorry, John, there's some real nuance when the data, when you look at equities, bonds, currencies, commodities. I really don't know where to start this morning other than all the experts have been wrong.
Bond market yields lower in the face of a Fed that is slowly evolving the language and giving you a nudge. Just a little look, a wink, a flirt with a conversation about tapering at some point in the next couple of meetings, Tom.
I'm going back and I'm rereading people looking for a measured yield or a measured and even lower yield. People like Stephen Major at HSBC, David Rosenberg up in Toronto, and they're not screaming higher yields. They're not saying 1960s or even some kind of elevated inflation. Like Hatsius at Goldman Sachs, they say this is transitory.
So let's talk about the pain trade, Lisa. What would assert the maximum amount of pain on the most amount of people? Yields higher, yields lower?
We've been asking that question, and more people are saying yields lower because people are expecting inflation to pick up. They are expecting the Fed to move away from easy money policies. And if we do get a move lower in yields at this point, materially so, what does that do in terms of growth expectations that have fueled the incredible rush into risk assets, John?
156 this morning on 10s, Lisa. In your equity market, 41.97 on the S&P 500, advancing about 1/3% on the S&P. On the NASDAQ 100, up 44, advancing about 1/3% there too. In a bond market, 156.38, yields are higher by about 0.5 basis point. No drama, a mild move. And in the FX market, a euro just slightly negative, down about 0.1% on euro dollar. Lisa, euro dollar 122.39.
Yeah, and I should just know, yesterday we talked about that 2-year auction. It was actually incredibly strong, and today we do get a 5-year auction of treasuries that people will be watching as well. All right, today we've got those Wall Street CEOs heading to the Senate to testify about how they were the stalwarts of financial stability during this disruption post-pandemic. The question will be, how much are they pressured by senators about the fact that they haven't lent out the glut of cash that we continue to see build on their balance sheets? Talking of the glut of cash, 1:30 p.m., the Federal Reserve is offering $500 billion in overnight repo operations. We've seen the take-up dramatically ticking up. This sounds really geeky. However, basically what this means is that banks have so much cash, they are dramatically looking for ways to park it and earn some sort of income with the Federal Reserve in a way that usually is not seen without some sort of financial market disruption, raising questions about the ongoing consequences of so much money in people's savings accounts and when it will flow out and to where. Also, 2 p.m., the SEC's Gary Gensler is going to be testifying in front of House Financial Services and Government committees. Question here is on Bitcoin. How much is the SEC going to come out in crypto assets and try to crack down or have oversight as volatility continues to pick up? I don't know how much is imminent, but the pressure is rising, John.
Lisa, thank you. I'm feeling so kind this morning. If you're just tuning in the previous hour, I actually quoted the Dow. Tom, yes. I'll afford you a little bit of time so you can quote the Dow. this morning, once again, if you want to.
Look, I think it gives us a great historical perspective,
Sometimes
John.
I'm nice, Lisa.
You know, and we're going to do that with our
occasions.
guest here in a moment. But, you know, John, I really think going over 125 years of the Dow Jones, the Wall Street Journal don't own it anymore, but they are on the advice of rejiggering it. John, there were 7, think of the change now, John, of Amazon. Like, will Amazon split so they can enter the Dow? That's a huge debate now among those in the know. But, John, seriously, there were not one but 2 17-year periods where the Dow didn't change its makeup.
Honestly, Tom, it's the conversation I have on the phone with institutional investors daily. Will Amazon split to get into the Dow Jones Industrial
Average? So then why do you say
the
Dow doesn't matter?
I'm
That's
joking.
sarcasm.
Steve Chevron joins us now from Venerated Hermes, the portfolio manager. Steve, please just put this debate to bed. Do you follow the Dow?
I've got to be honest. I'm a percentage move guy on the S&P. I'm not a point move on the Dow. It's just the way I was raised, I guess, John.
Things have changed for you, Steve. For me, just maybe not for TK.
Well, the only problem is now I know I've got a much more difficult interview with Tom for the rest of the session.
That's coming up in a couple of minutes. Steve, there is an issue with the S&P this year, though. You've got the market cap weighted with a heavy tilt towards big tech, and then the equal weighted S&P to give you a little bit more of a cyclical flavour, a cyclical weighting. How important is it to look at things a little bit differently this year?
I think it's really important because if you're trying to beat a benchmark or you're trying to outperform the market, tech hasn't been terrible. You're not down a bunch, but it certainly has underperformed. And that was the call we made, last fall where we went overweight cyclicals. I just think you're in a scenario where you've got consumers sitting on $3 trillion in extra savings. Banks can't lend the money out because people don't need to borrow it. I mean, you're just flush with cash. And I think we haven't really even seen all of the reopening. If you look at, some of the metrics, only 45 or 55% of Americans report being comfortable going to a restaurant. That hasn't come back full force. You've got New York, California, very large states, high percentage of the population just now starting to kind of come back online in a bigger way. And so I think the cyclical trade has some room to go here.
Steve, what's so important here, and I'm going to allude back to the Dow Jones Industrial Average. For those of you younger, it's an important index across finance. Steve, Grandpa Keene loaded the boat on Studebaker and went down in flames. Studebaker was part of the Dow. It was a buy and hold for Grandpa Keene, and in the 60s, of course, it blew up. What's a Studebaker in 2021?
Oh, that is a tough question. I think what you're getting towards, what is the blue chip that blows up? And I don't think you have a blow-up story amongst the big tech companies, right? Those are the blue chip companies, that we're looking at today. To underperform doesn't mean that there's a wreck. And I think that's the story here. And you guys were just talking about rates, and you were asking, what's the pain trade? Well, I think the pain trade is lower rates and then long tech on that same trade. Because as I look out, at our scenario, we think, either we're dealing with a kind of nice growth period that doesn't yield hyperinflation. That's probably our base case. Or a high growth period that does yield an inflation upside. In both of those cases, I want to be overweight value. I want to be overweight cyclicals. I want to be underweight bonds. But that 10% probability that, maybe growth has peaked, maybe we start to slow down, not to, 3 to 5% growth, but to below trend growth. That's an environment where you don't hate bonds and you really want to be back in the tech names because they're creating their own growth. That, to me, is the pain trade, and it's the one I'm a little bit worried about if that comes to fruition. I know I didn't quite directly answer your question because I don't know.
Yeah, you went down a flame.
No, I think that you directly addressed a question that we had yesterday, causation versus correlation, which also will get Tom Keene very heated. Do you think that there is causation that lower yields is causing more money to go into tech, for tech to outperform, or do you think it's just a correlation in terms of their earnings potential, regardless of the economic cycle?
No, I think there's a tight link, and I think what it has to do with is the idea of equity duration. A growth stock has a high duration. You're giving that company money for them to reinvest so that you can get cash flows out in the future, right? It's essentially a zero coupon bond. Whereas when you're dealing with a cyclical company or a particular dividend-paying company, you're getting a payment periodically. And so you can think about that as a coupon-paying bond, and that has a lower duration. You're getting your money back faster. So in a rising rate environment, you want to own shorter duration assets, and you're going to not like longer duration assets. Same thing that happens on the fixed income side. And I think that's the linkage between that 10-year yield and what's going on with the growth value trade.
Steve, just finally, sticking with this cyclical trade, which is something you're leaning into, I think. How do you do that when the likes of Lindsay Piegza come on shows like this and say, we're going back to trend, 1.8% GDP growth in the next couple of years? How do you stick with that trade in that environment?
It's easy. You disagree. I mean, I think the Fed is broadly right that you have quote unquote transitory inflation and a return to trend growth, coming. We just think that inflation is not quite as transitory as they think it's going to be. It's not going to be settled by the end of this year. We think it bleeds into next year. And we think likewise that growth will get back to trend, but it's going to take a bit longer than we think. And the primary reasons are you've got all that pent up savings that's going to take a while to get spent. And producers of goods are not going to get fooled this time by overproducing. So even in the face of higher prices and greater demand and supply shortages, we think producers are going to be very disciplined about how much they produce, and that's going to keep a little bit more upward pressure on price for a longer period of time. So I don't disagree that we're going back to trend. I just think it's going to take us quite a bit while longer to get there.
Steve, good to catch up, as always. Steve Chevron there
Thank you.
of Federated Hermes, portfolio manager. Your equity market up a third of 1%. The best read for me so far on the south side this week, Tom. Savita Subramaniam in Bank of America saying the following: the S&P 500, 70% less labor intensive than in the 1980s. Just the evolution of the index, which I guess is a theme for us this morning, and I think that's key.
Yeah, it's a huge deal, John, and it goes down to this strange phrase, productivity, which is beaten up and pounded. It's a 3-ratio dynamic. It's really complex. But the technological advancement in the shift, John, from labor-intensive manufacturing over to what we know with the computer is profound.
You have these big names, Lisa, the likes of Facebook, with massive market cap that dominate an index like the S&P 500 with very few employees relative to the companies of old.
It's an amazing story, and it's the reason why they have become the stalwarts of the entire equity market, not only for the U.S., but you could argue worldwide. However, you do wonder then what kind of impact it would have if we saw some of these suits, for example, on Amazon, the antitrust suit that came out yesterday. If you see increasing pressure on that, what it could do economically. Right now, not moving really shares at all.
What do you got to say, Tom?
I think Procter & Gamble, and it gives you perspective looking at the Dow Jones Industrial Average with Procter & Gamble.
He's going to keep going.
Forever. That's 99,000 employees, John, and you compare that. You can do this, folks, under the DES symbol on the Bloomberg.
Yeah.
As you mentioned, John, Facebook was 61,000 employees.
Yeah, and a market cap of about 930 billion.
Are you okay there?
You were fantastic.
Thank you.
This
Procter &
debate,
Gamble
Lisa,
is part of the S&P 500
this debate,
as well.
Lisa, has been going on for a long time, and I imagine it's going to be going on for years still to come.
Decades.
Well after you and I are long gone, Tom.
When's Amazon going to split?
I have no idea. I'm not going to comment because I imagine at some point they will, and then I will not hear the end of it.
No.
Greg Bowdle coming up soon from BNP Paribas alongside a fired up Tom Keene, Lisa Bravitz. I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The European Union is aiming to hit Belarus with a new round of sanctions by June over the forced landing of a Ryanair flight and the arrest of a journalist. Bloomberg has learned the strictest measures could target a soil nutrient used to improve crops. It's Belarus's biggest export item. The EU has already sanctioned 7 Belarusian entities and 88 individuals. Secretary of State Antony Blinken is in Egypt on the next leg of a diplomatic mission aimed at shoring up a ceasefire between Israel and Hamas. He'll meet with top officials, including Egypt's president. Blinken has vowed to rally international support to rebuild Gaza, whilst also promising to make sure that none of the aid destined for the territory reaches Hamas. In India, more than 2 million people have fled their homes as a powerful cyclone hammers the east coast. The cyclone is packing winds of up to 96 miles per hour and may push sea levels 10 feet above regular levels. It's the second severe storm to batter India in 10 days and comes as the country battles the world's worst outbreak of COVID-19. And one of Japan's most influential newspapers, itself an official sponsor of the Tokyo Olympics, is calling for the event to be cancelled. The paper says it would be, quote, unforgivable to go forward with the Summer Games and risk the further spread of COVID-19. It's the latest blow for the Olympics, which are scheduled to start July 23rd. Many parts of Japan remain under a state of emergency. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Brutus.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
My view and the general Fed view that these pressures are most likely to be transitory. If we're wrong, and of course we could be wrong, I think we have the tools to address inflation.
That was Randall Quarles there, the Federal Reserve Vice Chair for Supervision. If Senator Warren has her way, his time will be short-lived at the Federal Reserve. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equity futures up 14. We advance about 1/3 of 1% on the S&P, just short of 4,200 on the S&P 500. Yields are higher by almost a basis point to 156.55 after heading south in yesterday's session, even with the suggestion that we could be inching towards a conversation about tapering. Euro dollar, just a little bit of a weaker euro in the mix, down about 0.1% and change on that currency pair. Euro a weaker, dollar stronger. Euro dollar, Tom, 122.30.
Okay, traders. Okay, are you doing okay? Let's place stop on profit for euro. Let's move further. And I'm going to place stop on profit to 122.37. It will give us 5 pips, 500 pounds. So if you decided to follow trade, it took us, when we entered trade position 11.15, right now 12.20. What time is it right now? 12.20. So we're already in 500 pounds in profit. Okay, stay with me. Stay with me. This is not the end because we're still holding position. So you have to move your stop on profit to 122.37, and let's watch. Let's see what's going to happen next. Stay safe.
Tom, absolutely. Well, there's really no escape these days for the lawmakers trying to dodge this infrastructure bill. It's front and center here in Washington, D.C. Republicans and Democrats are both engaged, which is a positive sign of bipartisanship in an otherwise gridlocked D.C. that we've seen in the last couple of years.
But are we going to get anything done in June? Seriously, Washington is steaming. It's built to shut down in the summer. Do we get action this summer?
Well, Roger Wicker, Senator Roger Wicker from Mississippi is slated to, with other Republicans, give the latest counter-proposal to Joe Biden's infrastructure plan on tomorrow. The White House and Republicans alike have indicated that this week is a crucial one. So depending on what we see come out of that counter-proposal tomorrow, they may request a meeting with President Biden. We maybe could see something in June. Chuck Schumer has said that the Democrats are prepared to do something one way or the other by July at least.
Do we have a sense, Mario, of this $1.1 trillion plan, that's what it's said to be, from the GOP that they're planning to deliver possibly as early as tomorrow to President Biden? What's in it?
Well, not quite clear just yet what's in it. It's been closely held to the vest by the Republicans. The headline number, of course, which is quite surprising, is that they are prepared to meet him at that $1 trillion figure. The president, we know, tempered his proposal last Friday by dialing back some spending on roads, bridges, and broadband, and then said that he was open to putting some of the other spending in separate bills. So it would assume that the Republican counterproposal would be along those lines as well.
Is it going to be just filled with earmarks and pork, or is this basically something that is in good faith on all sides?
By all indications, again, this is Washington, D.C., I'll add that caveat. By all indications, it does appear to be, at this point, good faith negotiations. Again, the fact that Republicans are engaged, particularly after a bit of a speed bump last week, kind of shows that both sides are engaged in good faith efforts here.
What is the role of Ron Klain in this? He's extremely esteemed on both sides of the aisle. He is advising the president. He is the traffic cop, if you will, into the president. Mario, what does Ron Klain do in the coming weeks to get this started and get this done?
Yes, well, one thing that Ron Klain has done and what President Biden has done is continue to have the Oval Office with an open door. That's meant a lot. Republicans have taken that opportunity as well. The White House, there was a little bit of sniping earlier this week, I will add, though, between Republicans and the Biden administration on whether or not President Biden was the one who signed off on that counterproposal last week. The White House maintains that it was him. Republicans kind of insinuated that aides got in the way of the negotiations. But again, the positive sign is that both sides are continuing to engage.
Mario, just quickly, some hearings a little bit later with the big CEOs on Wall Street. What are you looking for?
Yeah, well, what you guys have been having front and center today, inflation. The White House this week, yesterday, Jen Psaki said that that's something that they're actually concerned about with housing prices, affordability, et cetera. So let's see how that comes up in some of these hearings.
Interesting. Mario Parker, got to leave it there. Got to catch up. Bloomberg White House reporter down in D.C. this morning. A little bit later on, Tom,
33 degrees
we'll
centigrade.
hear from the CEOs of Wall Street's biggest banks down on Capitol Hill.
What are they going to do? They're going to line up. They're going to do this thing,
understand.
right? John, they're going to do this thing. They're going to line
That
up.
thing with their hand in the air.
Testimony thing in the air. We take some photos, and then what's the then what?
They'll get some questions.
Come on, it's totally predictable.
The optics, the theatre. I said that earlier. I'm with you. We're on the same page.
No, we're not. I'm at 91 degrees Fahrenheit, and you're at 33 degrees centigrade.
Well, hold on a second. There actually could be something interesting said. I mean, potentially, it could be something that isn't theater if some of the senators drill down into, as Mario was talking about, inflationary dynamics and what they're seeing in credit card spending, what they're seeing on the margins with respect to loan demand. I'm just saying, theoretically, these are some of the questions that I think people in markets want to know as well.
Just in terms of the probability, Lisa, through several hours of testimony, hours and hours of testimony, there is likely to be something interesting in it.
Thank you.
Okay. But more broadly, it is often the same story, isn't it? It's the soap opera. It's the video clip that you send out to your constituents.
It's going to be, you guys make millions of dollars in the evil city of New York. What are you going to do for Main Street? Both sides of the aisle.
And they'll say they've been doing a lot over the last year.
They will. They'll line it up as Jamie Dimon does in his annual letter.
Here's the real test. Will we talk about it tomorrow morning?
I think that there will be some things within there that we will.
That's fair, John.
I do think that there will be. And I think particularly with respect to spending, consumer spending and loan demand, I expect they will come to Washington, D.C. with some projection for when they expect loan demand to pick up, why they've seen a decline. They will be answering those questions. And honestly, some of those answers could be interesting.
John, we're going to see a headline. It's going to be Senator Farrow says Jamie Dimon is crackers. That's where we're.
I can become a senator, can't I?
Yeah.
Can I become a senator?
Not a president.
I can become a governor, right?
I believe so.
But I can't become the president.
Are you thinking of it?
No, I'm just thinking of.
Why did you jump into the
Have you ever watched
mayor's race?
Succession when the older brother talks about making a run to become the president, and they turn around to him and say, "But you've never had a job." But he's convinced he's going to be a good president. Tom Keane would be a good president. Tika, that'd be great. You should run. Senator for New York.
He's speechless. He's just sitting there.
I have no idea if that would align with your politics. You've been very, very careful about covering that up over the years.
We have been covering this up. We do that. That is the Bloomberg way, Mr.
Of course,
Farrow.
of course.
Unlike that day when Brexit blew up and we heard a little bit of the Farrow.
Did I reveal my politics?
Look at those markets.
It was an hour 4 of the coverage, folks.
Tom Keane.
What are they doing in
Lisa
London?
Bradford, I'm Jonathan Farrow. Equities 4,200 on the S&P up 17. We advanced 0.4 of 1%. Yields up about half a basis point at 156.38. From New York, on radio, on TV, this is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance, and here's the price action this Wednesday morning. Up about 15 points on the S&P, through 4,200 again. On a NASDAQ, we advance about 0.5%. On the Russell, the small caps, also up by about 0.5. Switch up the board, here's the bond market, 2s, 10s and 30s. Yields this morning, up about 0.5 basis point through much of this morning. Your 10-year is 156.38. Yields were lower yesterday, even with this conversation about maybe edging towards a conversation about tapering at some point. The issue around inflation and what it means for the bond market, what it means for the equity market, just keep a note of the following stats, because I think it's really interesting. Savita Subramaniam and the team over at Bank of America, over the last 35 years, how labor-intensive the S&P 500 was and how labor-intensive the S&P 500 is now. We have gone per $1 million of revenue from 8 employees down to 2.3. So for every $1 million of revenue, sales, Tom, it's gone from 8 employees down to 2.3 since 1986. That is a big decline.
It's a big decline, John. It's a huge overlay to the markets. And I think we're making jokes about the Dow and all that, John. But the historical impact of an employee-less service sector can't be underestimated. It is a huge theme, not only the last 1 year, 5 years, last 30 years.
The composition of the S&P 500, part of that, and we'll build on it. I just get the S&P in there just for you.
That's good.
Finish on this then, TK. Euro dollar, 122.35, down by about 0.1%. Slightly weaker euro in the mix, but at least it's been on top of this over the last couple of days. The real currency pair to watch at the moment is not euro dollar, it's dollar China. Starting to see that Chinese strength continue. The Chinese currency, the strongest, I believe, in about 3 years on dollar yuan. So want to watch, Tom, in the FX market.
Well, it's going to be interesting to see, to say the least. We have a joy today on this day of 125 years of the Dow Jones Industrial Average, truly an expert on it. David Wilson, he's the Bloomberg stocks editor, and he comes out and he chit-chats on 4, 5, 6 stocks. But what you don't know, he invented the equity coverage at Bloomberg News, and we're thrilled that David could join us today. When somebody says Dow Jones Theory or Dow Theory, what is that?
Well, basically the idea that if a market's really rising, that the Dow Jones Transportation Average has to be setting new highs along with the Dow Industrials. And this goes back to, when the averages were much purer than they are now in terms of industries. So, if companies are making more stuff, the railroads and other, transportation companies need to be taking it places.
We're not going to go Richard Russell here, because, from another time and place. But David Wilson, Dow Utility Index, Dow Transportation Index, to John's valid point, are they fossils from another time?
Well, they're representative of their industries. There are a lot of other indexes that kind of cover the same ground now, arguably. But, because of the tradition, because of the history,
right.
I mean, you get something with the Dow averages that you don't necessarily get with the other indicators.
Can you predict Royal Caribbean will be a Dow component here in the next couple of years?
I don't know about that, but I can tell you that they're getting closer to, restarting, and not just cruises to Alaska. That's been the focus for the industry the last few days. The story today is that Royal Caribbean has received clearance from the Centers for Disease Control and Prevention to run test cruises of a ship called Freedom of the Seas from the port of Miami. So that's sort of a first step to being able to restart cruises from Miami as opposed to just from Seattle to Alaska, which is really what the industry's been talking about the last few days.
What else do you have?
We've got a company called Zscaler. They're big in internet-based security software. In fact, their market value is about
the
market value is about the same as Royal Caribbean, as it turns out. Their fiscal third quarter results beating analysts' average estimates in a Bloomberg survey, and they raised their fourth quarter earnings and sales forecast as a result. Now, this company's made a history of being well above projections, and they kind of kept that going last quarter.
Is that it, or you got one more?
I got one more for you. Please. Nordstrom, which is down in early trading. They had results out late yesterday, fiscal first quarter with a wider loss than analysts expected. Now, a lot of that was tied into a debt refinancing charge, but if you take that out of the equation, the number's still disappointing. When sales, while they were up 44% from a year ago, they were down 13% from 2 years ago, which in many cases had become the benchmark in terms of the recovery of companies from the pandemic.
Very good. David Wilson, thank you so much. Right now over to fixed income market. John was looking forward to Kathy Jones with Schwab joining us today. Kathy, work from home, and we've just got to understand right now that it is two trophy-taking end-of-pandemic pianos. There is the Kathy Jones piano shot, and there's the Stephen King over at HSBC piano shot. And for those of you on radio, all you need to know is Miss Jones is fabulous on piano, and she has a gorgeous, is this Steinway, Kathy, you've got behind you?
It is.
Looks
it's
absolutely...
1913 Steinway made in Germany.
Okay, so that can take us, John, back to the Dow Jones Industrial Average and where it was 125 years ago. Kathy, explain why yields are lower.
Well, I think a couple of things. We've seen some of the commodity prices come off the boil recently. We've seen some of the indicators that were just skyrocketing start to roll over just a little bit. The market's moved up over 100 basis points from the lows last summer. So I think this is a consolidation. And frankly, the talk about tapering can be interpreted as bullish for bonds. So if you think back to 2014, everybody remembers the taper tantrum when yields shot up on talking about QE ending. But when QE actually ended, when they actually tapered, yields fell. So if you look at it as the first step towards tightening, it isn't surprising to me that yields have come off a little bit.
Can you imagine a scenario where this continues then, Kathy? Would that be your base case, that the removal of QE will lead to lower yields?
No, I think we put QE aside, frankly. I think on the margin, it's somewhat bearish. It'll allow yields to rise. But I think the more important driver is where's the economy going? Where's inflation going? And the big difference between now and, say, after the financial crisis is we have huge fiscal stimulus. And we didn't have that the last time around. We've been much quicker to bounce back and close that output gap. So I think that yields do continue to move higher from here, but I'm not sure that it's driven by QE or anything else other than the economy and inflation expectations continuing to run pretty strong.
Within the breakdown of any given yield right now, Kathy, when you look at inflation expectations, real yields, is it real yields that needs to adjust a little bit more? And what kind of adjustment are you anticipating?
Yeah, that's the conundrum right now. I'm not really sure why real yields are as low as they are. Partly, I think inflation expectations have run up pretty rapidly in anticipation of more inflation. But I do think real yields have to come back. So that's one reason we expect yields to go back up on the 10-year to 2.5% potentially. I think real yields have to adjust if we're going to have real growth in the economy, which is what we have.
Kathy, how high can benchmark Treasury yields go before disrupting financial markets enough to create this feedback loop to send people back to safe havens?
Great question, Lisa. I'm not 100% sure that I have the right answer to that, but I think what we would probably need to see is kind of that not only to see, 2.5% on the 10-year, but start to see the belly of the curve move a bit more. It's starting to move just a little bit, but you start to get the 3-year, 5-year, et cetera, moving up, then the overall cost of capital starts to go really higher, because then the refinancing that's taking place 5 years out on the curve starts to get more expensive.
Kathy, are you going more into riskier credit with the hope and the expectation that the Federal Reserve will backstop markets enough to allow these credits to continue to pay out bigger coupons, giving you the returns regardless of deteriorating credit quality should that happen?
No, it's, again, a conundrum in the high yield market. This is a great environment for high yield because you have all this fiscal stimulus, you have pretty easy monetary policy, you've had the backstop from the Fed, which I think is winding its way down, and you have some upgrades, right? As the economy's improved, we've seen some upgrades. The problem is high yield's kind of priced for perfection, particularly like triple C's. And so we wouldn't be real aggressive in that part of the credit market, because I think at this stage of the game, we'll adjust to more greater reality that some of these companies aren't that solid.
Hey, Kathy, what will be the market reaction as the real yield migrates to zero? Give us I think Schwab has such a expanse of what money flow will do. How will flows in fixed income change as we're shocked by a move to 0% inflation adjusted yield?
Well, if I just look at where our investors are, particularly our retail clients, but even the more institutional clients, they're hoping for higher yields, and they're certainly hoping for higher real yields to extend duration. So I would expect that as we see yields move up, if we're right about that, we'll start to see more investor flows into longer dated bonds. Haven't seen much of that recently because they're still pretty low. But I think that as yields move up, we'll definitely see flows in that direction. People are nervous enough about risky assets that they want something to offset it. And if you get positive real yields in bonds, it'll definitely, I think, move in that direction.
Kathy, always good to hear from you. Thank you. Kathy Jones there, Schwab Center for Financial Research, Chief Fixed Income Strategist. With your bond market today, pretty stable, unchanged on a 10-year at 156, Tom, on 30s at 225.
Yeah, but John, to your point, John, you've been really good about this, framing a 164, 165, and the range out to 174. John, nobody would have thought we were at a 156.38 right now. This is really, I know it's a small move, folks, but John, to me, it's stunning the move that's come in given the zeitgeist.
Not given what we're seeing in the data at the moment, given the year that we're about to have in terms of growth. But this is the bond market.
At 830, I believe it is.
This is the bond market. And when you're thinking about a deceleration later this year, what's the environment going to look like for the bond market? With a 12-month rolling view of the outlook, Lisa, and the months still to come, what does next year start to look like as we get deeper into next year using that 12-month rolling view?
And if Lindsay Piegza is right, we go back to a low-growth environment that supports yields at these levels. I thought it was fascinating, Kathy Jones noting that perhaps people are implying that tapering will lead to lower yields because it could potentially crimp growth in the near term. All of that has to do, though, of course, with how disruptive some sort of increase in yields in the near term.
Sure, and that, Lisa, used to be the idea.
Yeah.
QE would generate inflation expectations, push people out of the bond market. The removal of QE may be the opposite. Just wonder how long that dynamic lasts, Tom.
Push them into the Dow Jones.
Into the Dow?
Industrial average.
Okay.
Value add.
David Malpass is up next. World Bank president from New York.
David Malpass knows where the Dow is.
He does, yeah. Yeah. Up 12 on the S&P. We advance a third of 1%, up about 0.4% on the NASDAQ 100. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. More than 30 whistleblower protection groups are urging the World Health Organization to review the case of an Italian researcher who said he was pressured to falsify data in a 2020 report about Italy's coronavirus response. He resigned in March. The WHO says it didn't pressure anyone and that it removed the report from its website because it had factual errors. Canadian Prime Minister Justin Trudeau is beginning to sketch out a plan to reopen the U.S. border, but Canadians don't appear keen to rush it, and when travel does resume, they overwhelmingly agree proof of vaccination should be mandatory. Nearly half of respondents in an Angus Reid Institute poll released today said the border should remain closed until at least September. Billionaire investor Carl Icahn says crypto may be here to stay, but he hasn't bought any. In an interview with Bloomberg News, Icahn also said President Biden must be careful not to overstimulate the U.S. economy. And he said inflation, quote, already exists, and that will cause a correction. We'll hear more from Icahn at 2:10 p.m. Wall Street time today, live on Bloomberg Television and Radio. During the more than a year-long national lockdown, many Americans turned to streaming services for entertainment. Consumers turned to Netflix, Disney+, HBO Max, and others in huge numbers. Several services, including Peacock and Discovery Plus, launched in the middle of it all. A new survey conducted for Bloomberg by Chorus finds people are subscribing to more services than they were a year ago, and their budgets have gone up too. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This could be a very good summer for the world, where the way of avoiding taxes and changing the place where you pay the tax, and where the way of a tax race to the bottom is stopped.
That was the German finance minister there, Olaf Scholz, speaking to Bloomberg from New York City this morning. Good morning. Alongside Tom Keene, Lisa Brownwitz, I'm Jonathan Ferro. Equity futures up 12 on the S&P, advancing 1/3% this Wednesday morning. Equities elevated on the Nasdaq, up 61. We advanced just a little more than 0.4% there. Surprised in the last 24 hours. Vice Chair Clarida teeing up, maybe talking about tapering at some point, maybe in the next couple of months, maybe. Yields went lower, heading south. 156.38 this morning, up by about half a basis point. And just finally, euro weaker, euro dollar down about 0.16%, 122.31, Tom, on euro dollar.
John, thanks so much. This morning with Francine Lacroix featured one of the great market calls of all time, David Malpass years ago at Bear Stearns, screaming about the end of deflation in Japan. It was one of the truly great calls of the early part of the last decade. He is now president of the World Bank. David Malpass joins us this morning. David, you have always been one to say, let markets act. The market for manufactured vaccines is out there. Is it a legitimate market, or is it held up now by politics as so many nations are desperate for vaccination?
Hi, Tom. They are desperate, and I think it's really important that the countries that have excess free up those excess so they can go to countries which have vaccination programs. It's important to do that matching between the haves and the ones that are ready to actually put shots in arms. World Bank will have 50 countries by mid-year that are ready with the personnel standing by, ready to put shots in arms if the world will only let the vaccines flow. So it's not really a market. It's controlled a lot by the various governments and the options that they took out. That was good because it got supply going, but now there's a chance to really distribute the supply worldwide.
Who is your most important phone call to Washington or to London to get this done?
I've talked with the U.S. administration. There's several different parts of the administration. There's the NSC and there's the HHS, the Health and Human Services Department, and so I think there's got to be a consensus within the U.S. That there is sufficient supply and therefore it can be released. And I emphasize to countries that have programs in place. You saw the New York Times article, I guess yesterday, which described the waste that's going on for some of the distribution outlets. They go to countries that can't use it, and then the vaccines are burned because they've expired. So we want to avoid that and actually get people vaccinated that have systems in place. I repeat, World Bank has 50 programs. We'll have nearly $4 billion, more than $4 billion, ready to pay if someone needs money to facilitate. And importantly, the money can go to actual deployment within countries so that they can vaccinate, we hope, hundreds of millions of people.
Meanwhile, the U.S. has actually started to release much more vaccine to other nations that are in need recently. How much has the increased distribution from the U.S. and other countries forestalled the emerging markets crisis the World Bank has been seeing brewing?
It's important to know what the delivery schedules for those vaccines are and to know if they're going into countries that are prepared to receive the vaccines and actually deploy them, put shots in arms. And one of the big challenges in the developing countries, really worldwide, is the hesitancy. Some people don't want to be vaccinated. So one of the things we're doing in client countries is have a communications effort by the country to encourage people to be vaccinated. That's going to save lives, and it also brings the economies back on stream. So it's important to be vaccinated and to have a program of vaccination in these countries. I don't know where the U.S. Supplies are going, and I think I've called for much greater transparency in terms of the supply. The World Bank has put up a major website that shows all of our program documents. It takes a lot of preparation for countries to actually show they can vaccinate. So each of the documents is as much as 50 pages describing who will do the vaccinations, what the system within each country is in order to do it fairly, and how they'll be paid for, how the costs will be paid for. So I've encouraged others to do that too. The transparency is important.
David, this is a sensitive question. There is a question of which vaccine which countries actually receive. And this comes as independent studies show that, for example, Chinese vaccines have not been as efficacious as those created by Pfizer and Moderna. Is the World Bank placing an emphasis on the type of vaccine, the brand of vaccine that is received and given to specific countries, or is it any vaccine treated equally?
They need to be WHO approved or approved by a regulatory agency, the U.S., Europe, Japan, and there's only a few that have been approved. But one thing I emphasize is most of the vaccines are better than not being vaccinated, and so that's important. Initially in our January and February programs, it was mostly Pfizer and Moderna, and we're still using that. But it's very important that AstraZeneca, that Johnson & Johnson, that the Chinese vaccine even, which has now been approved at least initially by WHO, are available. And importantly, our programs allow different vaccines to be distributed in different parts of a country. Rural areas may want a different vaccine than hospitals in major cities, and we've described that in our programs. That's a really important part of getting the job done properly. So we're able to accept and use all of those that I mentioned, and there will be more, which is great. And we can also acquire or receive vaccines through COVAX, the international consortium, if it has supply. That's been one of the challenges, and that was discussed in the New York Times article yesterday.
David, that's an important distinction, and as always, we appreciate your time. You're often generous with it, so thank you. David Malpass there, the World Bank president. Finishing there on China, Tom, just to bring up the situation in Chinese markets, got to talk about the Chinese currency. 3-year highs for the Chinese currency. That is dollar yuan lower, Chinese strength.
Yeah, Abramowitz out with a great chart on Twitter front-running us this morning, John. She does that all the time. She's so quick out on Twitter that it's, worth following.
Because she's on Twitter at 4 a.m.
Abramowitz won.
I'm in the office at 4
Lisa
a.m.
Abramowitz won. Front-running us. What's the why here, John? Do we have any intelligent reason why truly renminbi has been out front with strength?
The officials there, Lisa, seemingly increasingly comfortable with the direction of travel.
Well, the idea here being that possibly a stronger yuan could offset some of the inflationary pressures seen by commodities. That's one theory postulated by some PBOC officials that have retracted since that view. So very mixed signals from that, John.
Because the weaker dollar leads to what? Higher commodity prices. Stuck between a rock and a hard place right now. Coming up, Greg Bowdle of BNP Paribas from New York City for our audience worldwide.
Kodak
on radio, on TV, not on the Dow. This is Bloomberg.
traffic.
Okay.
During the pandemic, no traffic at all.
Okay. Where do you see the oil market in about 20 years or so?
Non-existent.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Is not necessarily 100% comfortable with the Fed's ability to do everything that it says.
We've already had a bit of a melt-up in the first half of the year, so we don't necessarily see another melt-up happening.
The idea of transitory is a debate we will be having consistently until October.
Even if we get some decent CPI prints for the next several months, I don't think that's going to be enough to force the Fed's hand into tightening any time before 2024.
You cannot really push the story of average inflation targeting and then have a rate hike as soon as 2022.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast on Bloomberg Radio across this nation and Bloomberg Television worldwide. We say an interesting Wednesday.
Okay, traders, how are you doing today? We need to place stop on profit for our short position for euro even further. So I'm going to place stop on profit to 122.32. It will give us 10 pips. It means 1 pip equal 100 pounds. It will give us 1,000 pounds in profit. Okay, don't forget, we still hold stop on profit for position. We have long position. A few days ago, we purchased euro at 122.097, and we already have stop on profit. So let's see which one going to close first. Anyway, we're in both ways. It's kind of arbitrage, you can say. We have short position, we have long position, and on the middle, we will collect the profit. This is how it works. If you would like to get the strategy, how to find out how we trade, you need to go to companyi.co.uk website. Okay? Then when you will get the strategy, you can use our broadcast channel, you can practice the strategy, you can follow our trades, and you can start making new profit for yourself. Okay? I'll speak to you later, guys. Stay safe.
Over the past several decades. My question is, though, talking about all the cash that banks have, where else is it going to go if it isn't into stocks of companies that are paying higher dividends, that are actually producing profits, even if potentially at a lower pace?
And John Farrow, on this day of the 125th anniversary of the Dow Jones Industrial Average, I think of GM in the 20s and, of course, Dearborn doing so well. Look at that headline from Ford of what, John, you've been talking about, a changing American and slowing global economy. Ford to boost electrification by Amazon like $30 billion.
By 36%, expecting 40% of global volume to be all electric by 2030, Tom. They're the goals of this company.
No, I think our goal is to still be on air in 2030.
Well, maybe just talking to each other in 2022.
Let me get equities out of the way here. I'm going to quote the Dow Jones Industrial Average up 65 points, 34,336. The S&P, we look at it occasionally, 4,200 up 12.25 points. Critically, John, the VIX coming from 21 into 18.44. That's my lead statistic this week.
We're going through this really important transition. We caught up with Gabelli Funds earlier on this morning.
Howard Ward.
The transition towards recovery, from that towards expansion, and then from there deceleration. And what does it mean for this bond market? And that's got to be the key issue every morning we wake up. What are treasuries doing? What are they telling you? Right now, I don't know. 156 on 10s, but that's the story.
Well, it's a story there, and of course we noticed moments ago Lisa leading with that chart on strong renminbi as well. Lisa, what do you see in IG and high yield before we get to Greg Bowdle?
If you take a look at the extra yield that investors are demanding over benchmark rates and investment grade, it's at a post-crisis low. Basically, we are looking at the lowest spreads since the 2008 meltdown, and it raises a question about how much cushion investors really are receiving against potentially higher rates. Aren't happening.
I'm sorry, it screams 2006. I mean, to both of you, but John, I mean, to get to Lisa's profound insight there on credit spreads tightening, and then you see year-over-year Case-Shiller yesterday up solid double digits. John, I'm sorry, it's 2006.
You think it's a mid-2000s dynamic, mid-90s, a Federal Reserve that doesn't start hiking soon enough? Do you think it's that too?
That's the gloom crew. You know, the pendulum of 2006.
I will say that there is a difference in terms of the amount of leverage in the system this time, John. Just to be very clear, even with high-yield issuance at a record high, yet again, you aren't seeing, Tom, the same type of leverage, CDO squared, as you did in 2000.
You two swap roles this morning. What, you sounded almost bullish on credit then, Lisa.
I'm not bullish. I'm just explaining why it's distinct.
Okay, thank you.
Good. I think that's very important here, and you know, we have to have this banner codified there right now. You just heard it as a surveillance exclusive. We do breaking news and exclusive news, and we mold them in together. Then
We should
Lisa
cut that little clip, shouldn't we?
Is not bullish. Very important to see that this morning. Speaking of bullish, Greg Bowdle joins us, the BNP Paribas, to save the program this morning. Greg, are you bullish?
We are, but we're looking for a slowing rate of equity gains. There's definitely some storm clouds that we're concerned about. Credit is very tight. Valuations are very elevated. We do have this uncertainty in terms of the macro data when we look further out. But for now, we think there are a lot of tailwinds. Earnings season was chief amongst them.
Greg, the story of the moment. Growth's peaking. We go through this recovery phase into an expansion phase. That was what Howard Ward of Gabelli talked about earlier on this morning. When you start to make these kind of transitions, Greg, how do you make a transition just in terms of capital allocation?
I think one of the things that we've been talking about, you touched on this a little bit earlier, John, when you mentioned this move potentially, should you move from cyclicals into growth? And we think that there's maybe a middle bound. Yeah, we've had this extremely bullish environment for value in the cyclicals over the last 6 months. And rather than give up on that trade, we think it has further to run and jump back into growth. We think there's a middle ground where maybe we can start to look at value, but try and look at value with more of a quality tilt. And interestingly enough, in the context of your programming this morning, something like the Dow probably fits quite well in that.
Oh, here we go. Greg Bowdle, walk me through it. Are you telling me that in your strategy note, you're talking about how to get allocation exposure to the Dow?
We have been, and I think in the last 20 years, it's probably the first time I've talked about it. I think there is an argument that rich though the history is, the Dow is a little bit anachronistic in terms of how it's constructed. But when we screen through the global indices and we look for indices that have positive exposure to value, something like Russell comes up, but it has very negative exposure to quality. When we look at quality, things like the NASDAQ comes up, but very negative exposure to value. But something like the Dow actually fits quite nicely in between. It has positive exposure relative to the other indices for quality and value.
I think about, though, Greg, the idea that the Dow is really pegged to the old economy, and the old economy has gotten a boost from some of the infrastructure spending, the higher commodity costs, and then you get a headline like what we just got, that Ford plans to boost electrification spending by 36% to $30 billion, hoping to really ramp up how much of its fleet really is electric. How much could this bet in the old economy be disrupted by new economy, new environmental types of initiatives?
I think it's a really interesting question. And one of the things about the new economy, electrification, is things like copper are a very necessary input for some of the EV infrastructure or some of the green initiatives. So some of the industrial cyclicals are actually some of the stocks that are quite well placed to participate from this. And in terms of the expansion that we've had, yes, it's been driven by a cyclical recovery, a reopening trade, but we still haven't necessarily had the boost to come from infrastructure. When we look at things like the commodity complex, we had a commodity bear market in the middle of the last equity bull market. If you look at the trailing 5-year average for the capex spend from some of the materials or mining stocks, they are at incredibly low levels. So we have this very tight supply picture, and we have demand that, even though some of it is priced, is continuing to expand. And if we get a further fiscal boost from the administration for infrastructure in the back end of this year, that's going to drive more demand against tight supply. And I don't think that some of the traditional older economy stocks are actually that badly positioned to participate.
Greg, what's the biggest pain trade right now?
The biggest pain trade for the market is probably rates moving lower. I think there's been a huge amount of focus on rates starting to pick up, this reflationary cycle taper. That's what we've all been talking about at the start of the year. And you've seen it over the last 5 weeks or so that we've seen, the last 5 days or so, we've seen rates starting to kind of significantly drift lower. And if that happens, then I think some of the growth stocks that people have been rotating out of could well outperform.
Okay, final question, Greg. I'm a client. I receive that strategy note and I say to you, what are the securities I use, the tools I use? How do I get exposure to the story you're telling me? Do I go and buy an ETF in the Dow? There aren't many. What do I do?
Yeah, I think there are different ways of looking at this. The main theme that we've been talking about is coupling value with quality. And it is a difficult thing to do. But the way that we address this is we look at it on a sectoral level, an index level, and a stock level. And if you go and kind of filter through for stocks that have exposure to those two qualities, you do get an interesting mix of indices or underlyings. So things like the Dow in the index space, some of the materials and the metals and mining sectors, we think screen quite well in that context. And you can also take a totally cross-sectional view where rather than looking for indices and sectors, instead you filter by those individual stocks and try and build, in our case, custom thematic baskets that are really geared to those key themes.
Greg, Tom's going to want you back every single day.
I was tearing up there. I was, John, it was
Greg, that'll go away.
You don't get that from Constant at Goldman Sachs. I mean, you
don't know. BNP Paribas, US head of equity and derivative strategy. Greg, thank you. Equity futures up 1/3 of 1%. What was interesting is what Greg said in the commercial break, which I don't think he'll mind if we share on air. When we asked him about this Dow situation, Tom, and he said most of the streets following the S&P 500, but to be honest with you, my kids follow the NASDAQ. Yeah. There you go. That's the change.
And that's really NASDAQ 100 as well as a composite as well. John, one of the great Americans has died. The John Warner story is, they're going to play it off. He married an actress, I can't remember her name, years ago. John Warner enlisted in the Navy when he was 17 years old. He did the unheard of. He became a captain in the Marines in Korea. He was the Navy guy on the Hill. He was an absolute textbook Virginia politician out of Washington and Lee. And John, what this guy did, he was the last of the old guard liberal senators. He, in Virginia with a geography to the south, he was the one that for years fought off in the Senate the real conservative tilt of the Republican South.
The former Senator John Warner of Virginia died Tuesday at 94.
With the First Word News, I'm Ruchika Gupta. The UK Prime Minister's former advisor has unleashed an onslaught of criticism towards his old boss, saying he isn't fit to run the country. Speaking during a hearing in Parliament today, Dominic Cummings accused Boris Johnson of not taking the COVID crisis seriously enough from the start.
In any sensible, rational government, it is completely crazy that I should have been in such a senior position, in my personal opinion. It's just, it's completely crackers that someone like me should have been in there, just the same as it's crackers that Boris Johnson was in there, and that the choice of the last election was Jeremy Corbyn. It's all.
Cummings said the entire government is to blame and that officials had, quote, disastrously failed the public. The European Union is attacking what it calls AstraZeneca's vaccine supply failure and demanding an urgent order for millions more doses. In a hearing that kicked off today, a Belgian court is weighing EU claims that there's an emergency situation that merits an order for the drug maker to deliver 20 million more shots than it had promised so far by the end of June. Secretary of State Antony Blinken is in Egypt on the next leg of a diplomatic mission aimed at shoring up a ceasefire between Israel and Hamas. He'll meet with top officials, including Egypt's president. Blinken has vowed to rally international support to rebuild Gaza, whilst also promising to make sure that none of the aid destined for the territory reaches Hamas. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
much quicker to bounce back and close that output gap. So I think that yields do continue to move higher from here, but I'm not sure that it's driven by QE or anything else other than the economy and inflation expectations continuing to run pretty strong.
That was Kathy Jones, the Charles Schwab Center for Financial Research, the chief fixed income strategist on the bond market from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Just briefly, equities up higher, positive a third of 1% on the S&P. The Nasdaq up by 60, advancing 0.4%, and yields on a 10-year up around about, not even a basis point actually, 156 on a US 10-year this morning, Tom.
Very good. I mean, there's no other way to put it. There's a market churning, and the yield is, to me, the major story there as well. What we do in economics is we have deciles. 10% of the American public say is one estimation. Jared Bernstein is expert at the analysis, the breaking apart, the slicing, dicing of those deciles, those 1/10 of the American public. He is with the White House Council of Economic Advisors and has been a lead advisor to the President of the United States for over a decade. Dr. Bernstein, thank you so much for joining us today. Do you have an understanding now about which deciles have been advantaged by this historic fiscal stimulus? Who's benefited?
Yeah, no, it's a great question. One of the things you see when the job market tightens up, and this has been a theme of my work for decades, is that those in the bottom half, the bottom 5 deciles, if you want to stick to that metric, benefit disproportionately when the job market tightens up. You see the black unemployment rate come down faster in those situations. You see the wages of low-wage workers get a bigger pop. They're just a lot more sensitive to the kinds of bargaining power benefits that come from a full employment economy. So heading back to full employment as quickly as possible is one of the goals of our fiscal policy, and the American Rescue Plan is clearly helping to pull the recovery forward, not unlike comments I've heard on your show this very morning.
The kind of outcomes that you'd expect maybe later on in the cycle, Jared, are you starting to see them develop a little bit earlier than anticipated?
I'm sorry, what were you asking me about?
In terms of the outcomes you'd expect in the labour market later on in the cycle, which is when you really start to erode some of the slack, are you starting to see some of those symptoms earlier in the cycle? Are we starting to see them now as opposed to, say, several years down the line?
I think you're seeing a few, but it's more anecdotal and scattered. It really hasn't shown up in the data yet. If you look at the wage data adjusted for compositional effects, you see some promising hints here and there, and you certainly hear anecdotal wage offers that are getting a bump. I do think lower wage workers have some bargaining power based on these dynamics that we've been talking about. But remember, we still have a highly elevated unemployment rate, north of 6%. For blacks, the unemployment rate is 9.7%. So we still have a long way to go. But yeah, we're seeing some hints in that regard. And I like the way you teed it up, John, which is eroding slack. That's precise. That's just so important to middle and low wage workers.
At the moment, there's another dynamic that has become very political, Jared, as I'm sure you'll appreciate. More than 20 Republican states, the governors have basically gotten rid of the extra additional unemployment insurance. Jared, what do you think the consequences of that decision will be in the data that we'll expect to see in the coming couple of months, deeper into summer?
Yeah, it's a good question, and here's one of the natural experiments that economists love to tap. And we're definitely concerned about taking off enhanced unemployment benefits too soon. Every state's going to act on its own, and obviously economic conditions differ across states. The president has leaned into this pretty firmly, saying that people who are offered a suitable, safe job need to take it. That's part of the rules of the unemployment insurance system. But this system has been so important to helping workers, not just the standard base system, but also the added enhanced benefits for workers who are less connected to unemployment because maybe they're gig workers or self-employed. And so it's really helped people get through the recovery, get through the crisis to the other side. And along with the distribution of the vaccine, it's been one of the more important parts. Shots in arms, checks in pockets, that's been part of the formula.
Jared, do you see the enhanced unemployment benefits as being a template or serving as a template going forward for some sort of universal basic income, especially if the participation rate continues to fall as it has over recent decades?
You know, it's a fair question. I would probably say the direct impact payments or the checks are closer to that than the UI, the unemployment insurance payments. I mean, unemployment insurance is just that. It's a specific insurance program, a safety net for people who lose their jobs. And it's one that, of course, has been in place for many, many decades. It's proved to be an extremely important counter-cyclical force. I do think the system needs work, and the administration is very committed to doing that. If you listen to the president's discussion of making sure that the next time we hit a downturn, we hit it with a UI system that's more ready for that. That I think is an important part of our kind of policy infrastructure that we're committed to working on.
Dr. Bernstein, I want you to speak to a small business out there that is petrified of what they see from fancy big corporations of $15 an hour, $17 an hour, and up wages. I want you to study David Card and the wonderful Alan Kruger and the arch fear that if we raise those low minimum wages, all the other wages come up with it. What's your evidence on that study?
Yeah, so this is a very consistent finding around minimum wage increases, so that if the minimum wage goes up, many studies have found that there are spillover effects that give a bump to workers right above that minimum wage level. Again, as I mentioned earlier, we are seeing increases in low wage offers, and I think that's really important to people who are coming back into the labor market. Think of it as a price signal. You know, I was thinking of you the other day, Tom, because I was sort of thinking of this in my head, and what I thought was kind of a Keynean way, which was sort of like Keynes meets Hayek. You know, the idea that the stimulus, both on the fiscal and monetary side, really relief on the fiscal and monetary side, and you know the monetary policy also helping to move the recovery forward. You've got price signals. You've got price signals. You've got price signals that are pulling workers back into the labor force. You've got the vaccine. Promising developments.
I mean, he does this right at the end of the interview, John Farrell.
Isn't
I mean,
it
Dr.
nice?
Bernstein has set this up huge. You're going to come back, Dr. Bernstein, and I don't mean on Jobs Day. We love to have you with John on Jobs Day after the report. You've got to come back, and we've got to talk about the information that's out there that we can't see. We got to go on the edge of Joe Stiglitz and, you know, the others of information study.
Just because
Michael
he said he was
Spence,
thinking of you, now you want him back straight away.
Yeah, I only want him
Is
back
that
because
it?
he was thinking of it. Jared, do you look at the Dow Jones Industrial Average?
Yeah, I've heard about that. Look, when you're in the, here's the thing: when you're in the White House, you're very careful not to react to every blip in any index, you know, minute to minute or day to day. Much more heads down, keep the recovery going, deliver the goods to the middle class.
There you go.
I think that's
a very diplomatic answer there, Jared, and it's always always good to get you on the show. Thank you, sir. Jared Bernstein there from the White House, from New York City this morning.
Selma's got 3 new movies coming out.
Good morning. This is Bloomberg.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
Certainly feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Wednesday morning, good morning from New York City for our audience worldwide, live on TV and radio. This is Bloomberg Surveillance alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. 4,200 on the S&P, up a third of 1%, advancing 15 points. Yields unchanged on a 10-year, 155.87. Euro dollar 122.27. Negative there, 0.2%. That TK is a weaker euro, just a little bit of a stronger dollar there.
Really interesting. We're going to get to Betsy Stevenson in a moment, really to look at this linkage of policy into the American economy. But right now, all of us at Bloomberg Surveillance, Lisa Abramowitz, John Farrow, and myself say we need to stop the show. For Global Wall Street this morning, the definitive article is from Hannah Levitt and Sri Natarajan as they read in on the new CFO of JP Morgan. This is a really, really important story for all of Global Wall Street because he failed. Sri Natarajan, explain to us how Jamie Dimon is selected and Daniel Pinto is selected a CFO that has enjoyed failure.
It is just an incredible career arc, Tom. If you look across Wall Street, it would be hard to find another resume like this rising to the topmost seat at a bank. Here's Jeremy Barnum, who started at JP Morgan back in 1994, armed with a degree in chemistry from Harvard College, was part of the pioneering group that was just starting out the credit derivatives market, the CDS market, had a big prop trading role and blew up, was fired from JP Morgan over it, went to another hedge fund, fired again, but then was lured back to JP Morgan, and since then has just been an incredible comeback story and is now the CFO of the nation's largest bank.
What does he bring there? I mean, you look at JP Morgan and you look at the whale and all the other failures, AIG and such. He brings prodigious mathematics skills with his chemistry degree. He brings grunt and all the heritage and that. But what is the specific skill Jamie Dimon wants from him as CFO?
So let's look at really the second innings of his career when he returned to JP Morgan, 2007, the same time, in fact, possibly the same day the two hedge funds at Bear Stearns were blowing up. Then came the 2008 Bear Stearns acquisition. He had a big role to play in it. He was a junior staffer then, but that's when his first interactions with Jamie Dimon started. Then making sure that the firm was avoiding all the pitfalls from the collapse of Lehman Brothers, the cleanup of the London whale trading scandal. He played a role. He played a role in that. In fact, the antagonist in that whole scandal was Blue Mountain, his former employer, and Blue Mountain also helped JP Morgan unwind some of his trades. He was central to that process. He was right in there trying to clean up that mess. obviously that got a lot of acclaim at the top rungs, and since then his career has only been on an upward trajectory.
Sri, there's a cliche on Wall Street that if you lose $1 million, you'll get fired. If you lose $10 billion, you'll get hired, and you'll be sort of rewarded for taking big risks, even if they fail. Is that part of the story here, or is it a distinct tale of someone who brings incredible credentials?
It is different in that back in 2004, I don't think JP Morgan was losing that kind of money. Yet he was in what was a prop trading role. He was the head of their credit trading business in North America. This was a group that really operated like a hedge fund within JP Morgan. They used massive derivatives, cash bonds, and these were the derivatives markets was just taking off at that time, and JP Morgan was central to it all. But then came the blow up. Jamie Dimon had just joined the franchise with the acquisition of Bank One. He was the president, and he was responsible, or at least he was overseeing some of the restructuring of the fixed income unit. And he went out. But to JP Morgan's credit, they recognized what they knew, but they also recognized what they didn't know, and had to bring back someone who had the immense expertise in the derivatives that still sat on JP Morgan's book. They needed
Got to jump in, sir. Some breaking news. Amazon MGM Studios, the purchase price $8.4 billion. They've signed the pact for Amazon to buy MGM. That just crossed on a Bloomberg terminal right now. Amazon agreeing to buy MGM Studios for $8.4 billion. Just a little bit lower, Lisa, than the $9 billion that was circulating in the news over the last week, as Wall Street Journal was the first to report on this deal.
And there's a question here, especially as big tech tries hard to get into media and into this business. How many streaming services, how much people are willing to pay, and whether it's a good deal to buy at the peak jump.
Well, there was talk that Apple was in the mix for this particular product as well, for this content, Lisa, and Amazon just came in big. Came in much bigger than anyone else was offering.
Yeah, they have the cash. The question now is it going to be worth it at a time when some people say it's peak content, right? I mean, we see it absolutely everywhere.
So that headline, Tom, just crossed on a Bloomberg. Amazon agreeing to buy MGM Studios for $8.4 billion. The purchase price, $8.45 billion, widely expected over the last week. But that's the official headline crossing the Bloomberg terminal this morning.
The value of enduring copyright. We'll have much more on that through the day. Right now, we endure in American economics, and there's no one better than Betsy Stevenson of the University of Michigan, the professor of public policy and economics, and far more a student of our social economics across this nation. Betsy, I got 8 ways to go with you always. You're so prodigious. But the single way I'm going to go right now is what I've observed, Lisa Abramowitz observed, John Farrell's observed. Women are flat on their back in this pandemic over child care. Let's revisit it. Why is America medieval in our public policy on child care?
Oh, well, the why question, that's sort of hard to answer. I can sort of tell you how we got there. Which is that, people really decided that childcare was kind of a personal issue more than a societal issue, something for families to solve on their own. And we even saw the beginning of the pandemic. I mean, it was breathtaking to me the way that Congress tied itself in knots to save the airlines. And they barely asked a question of who's going to take care of the children and are we going to be able to keep them safe.
Betsy, well, there's a question about why there has been this incredible friction, that there are all of these job openings, and that people are not going to apply for those jobs. There has been some theory that it is because the enhanced unemployment benefits are bigger than the salaries, but there are other theories that it's because people have kids at home and they have other family obligations. Have there been any economic studies done on that?
Yeah, so actually, Jason Furman and Melissa Kearney with another co-author, who I'm blanking on right now, but just took a look at the data, and they said, look, it doesn't look like child care is really holding back the economy. I mean, first of all, realize that mothers are only 12% of the labor force. So even if mothers were really struggling, they're still a small share. I'm going to tell you, it's a different answer than I think you're hearing from a lot of people, which is, there's a lot of openings, but nobody's really sure what kind of job they want to go into now. And so what we've got is just a great reshuffling, and it's going to take people a little while to figure out what they're going to, because things have changed. You used to work in retail and you never thought of that as a dangerous job. You didn't think you were going into the coal mines. Well, retail turns out to be kind of dangerous. People are aggressive towards you. There's contagious diseases you could get. Same thing's true with working in hospitality. And I think a lot of people are trying to figure out what their next step's going to be. And I think a lot of businesses are trying to figure out what their next step's going to be. Look, when you only see 266,000 new jobs added, you can't blame that all on workers. There's not 8 million people sitting at home thinking, I don't feel like working this month.
Well, Betsy, this raises a question of whether these frictions could potentially persist for longer than people expect. If this is a matter of the jobs not necessarily being good fits for what people actually want to do every day, could this be a longer lasting phenomenon than people expect?
Well, look, I think that kind of frictional unemployment eventually works its way out, but it is going to be a slower slog than I think people have been thinking. For the last year, people have said the pandemic will go away and the next day everybody will get up and go back to work. Look, people are vaccinated and they're still not ready to get up and go and do things the way they did them before. I don't think we're all going to get back and do everything exactly the way we did before. And that same thing is true for work. We got companies trying to figure out how they're going to get remote workers back in the office. There's a lot of adjustment that's going to happen, and it is going to make things slower than people expect.
Betsy, what is the total pie of the government support of this, or the government part of this economy, versus what more conservatives would suggest is a socialism of France or Sweden or others? Their response is, we don't want to be like France. How close are we to being France?
Well, we're very, very far away from being France. So we're, what we collect in revenue, what we spend out in terms of a share of GDP is much smaller than those other countries. I think there are two big questions here, though, that I want you to separate. One is, how much stimulus do we need? Do we need to be supporting people right now? Are we going to recover quicker if government's putting money out there? That's one question. Another question is, what kind of social infrastructure do we want? Do we want the government providing education? If so, how much education? Is it just K through 12? Is it university education? Is it early childhood education? Do we want childcare in the mix? What do we want government to provide? And I think the pandemic has forced a lot of people to ask that question. You've got a big push coming out of the Biden administration for a very different vision of government and the kinds of social support that's going to be provided. That's not about the pandemic, but I do think the pandemic caused people to say, hey, wait a minute, I want more from my government.
Okay, but Betsy, this is an unfair question to you. We talked to market economists, and some are looking on demographics and nominal GDP as a run rate 2% American economy. Do you share that view, or can we not get back to morning in America, but can we have a better run rate of real GDP?
I think the idea that, we go back to the Trump administration, and the idea was we're going to get faster real GDP growth if we just stop taxing everybody. And that just doesn't work. If we want faster real GDP growth, the only way to do it is for us to invent ways to do more with less. And the way to invent ways to do more with less is to start at the ground level, which is invest in our people. So I think if you want faster GDP growth, you invest in early childhood education. That's not going to get us fast GDP growth tomorrow, but I'll tell you what, it certainly will in 30 or 40 years. The U.S. used to have the most highly educated population in the world, and we had the fastest growth. We've now slipped in the world so that we're barely in the top 10 in terms of highly educated workforce. No wonder our growth is slowing. So I would say there's no easy fix here. There's no crash diet to faster GDP growth. We got to invest in the people who are going to become more productive and going to come up with new ideas and going to give us that faster growth.
Betsy, we got to run. We got to leave it there. Thank you. Betsy Stevenson there at the University of Michigan. Just to return to that breaking news in the last 10 minutes, Amazon agreeing to buy MGM Studios for $8.45 billion. Just a little bit left than the guide that we got over the last week in the reporting. We were looking for something in and around $9 billion. It comes in at $8.45 billion, the largest acquisition for Amazon since the $13.7 billion deal for Whole Foods going back 4 years ago in 2017. Coming up on The Open, we'll discuss the deal and what it means for the environment. Richard Bernstein advises Deputy CIO Dan Suzuki coming up a little bit later, Tom.
You have Suzuki coming up?
We have Dan Suzuki. Ashok Bhatia of Neuberger Berman on the bond side of the story. I do know Richard, yeah.
Richard actually looks at the Dow Jones Industrial Average.
I'll ask Richard about that. I'll ask Dan about that too. Okay?
We'll continue. John Farrow, 9 o'clock, really
Thank
important
you.
here, of course, with this important Amazon story. On that, Geetha Ranganathan joins us with Bloomberg Intelligence, our media analyst there, and with Robert Schiffman on the bond side. Really fabulous coverage. Geetha, I know that Schiffman has written about this is like 1 day of revenue for Amazon. I get that. Is this the beginning of something bigger for Amazon? Do you look at this as an incremental step, or is it literally a dalliance for a retiring Jeff Bezos?
Thank you, John. Thank you, Tom, for having me. So I think this is really a bold step, and this kind of speaks to Amazon's ambitions in streaming. They've really doubled down, if you will. Just a few weeks ago, they announced $11 billion deal with the NFL. So they're really serious about streaming, and now they're getting a studio, an iconic MGM studio with 4,000 movie titles and 17,000 TV shows. So they are really going big, in my opinion, in streaming.
Okay, they're going big, but for all streamers, it's not been a bed of roses. I mean, there's Paramount Plus. I guess this could be MGM Plus. I don't buy it for a minute. What is the aspiration of Amazon when you can compare and contrast them with the other streamers?
So they really want to be a top-tier service. I mean, this is a move that is coming very closely on the heels of the Discovery Time Warner. So we're looking at everybody kind of really looking to consolidate their position. We already know Netflix and Disney kind of lead the space. HBO Max now a potential top contender for that streaming crown. You see Amazon, I mean, the Prime service has always been important for people, but this is really where they're making that big bet in video.
Yeah, I know, Lisa, you've seen Mandalorian, what, 4 times at your house?
Yeah, we hold screenings for the entire floor. There is a question of how much harder it gets, though, Geetha, to keep some of your subscribers at a time when there are so many rivals. And it raises a question of whether the barrier to entry and the barrier to continue maintaining market share is getting higher and more expensive. Is that your sense going forward at a time when so many different outfits are putting such priority on content?
Oh, absolutely. I mean, it is going to be harder and harder, not just to retain subscribers, Lisa, but also to attract subscribers, but also to kind of retain them. And that's really what Amazon is trying to do here, right? Because they're getting a studio. They're not only getting that deep library and that, trove of content of very many movie and TV titles, but then it also allows them to make those new buzzy shows. And we've seen the MGM TV studio has come out with some really good stuff with Handmaid's Tale, with Fargo. So, again, they really have that firepower to go ahead and attract a whole bunch of new subscribers.
And true story, I lived in Fargo for a while, which dovetails into our conversation with the North Dakota senator. There is a question, though, Geetha, going forward of whether this is too high of a price at a time of such incredible emphasis on content. We're coming out of a pandemic where no one else had anything else to do. Is there a sense that perhaps some of this content is perhaps being bid up a little too high?
I don't think so. I think this is an arms race, and content creators need to get paid. Yes, the price of content has really gone up dramatically in the past few years, but I think it is going to go up more and more because this is really how you attract subscribers, and this is how it is the name of the game when we come to streaming and when we come to media. So I think you can only expect it to go up a little bit further.
Geetha Ranganathan publishing today on Amazon MGM for Bloomberg Intelligence as well. Lisa, they're moving at light speed. What I find fascinating here is all the negativity, including the Amazon annual meeting and all sorts of shareholder rights issues and the politics of Washington. And all of these companies just every day they're moving forward with massive profits and what to do with it.
Yeah, I mean, basically, they have so much cash, Amazon. What are they going to do with it? Why not buy a movie studio? The question that I have, though, is this going to pay out longer term? They already have these Prime subscribers. Is this going to really move the needle? And I think that people are saying, yes, if you take a look at pre-market shares, they are up for both MGM as well as for Amazon.
Well, I know Robert Schiffman publishing today on the credit quality of Amazon, and, they don't have nearly the credit rating of the other major tech tech fangs because they've been investing. But Schiffman makes very clear that Amazon, with the enduring cash flow, particularly from AWS and cloud, can migrate towards that credit rating. We'll see much more on this through the morning. Really looking forward to talking to Paul Sweeney on Bloomberg Radio in a moment about Amazon and MGM. Joining us right now, and I am going to rip up the script here, and I can do that, of course, with the gentleman from the Dakotas. Kevin Kramer is with North Dakota. I've always got to keep my Dakotas careful here. I've got to be careful what I do. Senator Kramer, I want to stop for a moment for you to speak of the symbolism of your Republican Party and the path from John Warner dying today at 94 over to the modern Republican Party. You have identified, I love the idea that I think like Lincoln, you lost your first 3 elections. Tell me how your GOP keeps the Republicans like John Warner and frankly Senator Portman of Ohio in the fold. How do you keep these liberal Republicans in the party?
Well, no, thanks for the question. Actually, pragmatism works, and I think that one of the things that Donald Trump brought to the Republican Party is he brought the working class Americans to the Republican Party. I think at the end of his 4 years, one of the things we lost, perhaps, are not so much moderates as probably the polite, moderates, if you will. Certainly the suburban women, for example. All of that said, I think that we take the Trump mantra, and that is to say the more less globalist, but an America First globalism, a populism conservatism, and apply it in a gentler way. Not shyly, by the way, but I think we have the right governing philosophy to be a majority party. And I just think that, and the other thing is this, quite honestly, Joe Biden is going to help us immensely. If we can get out of our own way and keep highlighting the Biden agenda, which includes everything from destroying American energy while building up Iran and Saudi Arabia and Russian energy. If we talk about, putting so much money into the marketplace that we create hyperinflation and all the other stuff, the border crisis, what's going on in the Middle East, his lack of attention to the really big issues. There's nothing like a common opponent to help unite people. But I do think our own message, to your point, needs to be the Trump message delivered in a way that people are listening.
And the lessons learned of losing the presidency, losing the House, losing the Senate, and granted these are by all small numbers, and 2022 beckons, how do you coalesce the GOP on social issues so removed from the core Trump constituency, and I might say social issues that Senator Warner of Virginia led with through the 70s and the 80s?
Yeah, so I think there's a couple of things. One is we're seeing a trend that actually does benefit us, a demographic trend, and that is that the Hispanic Americans are coming more our way. And they came more our way under Donald Trump. They became our way because of Donald Trump, because they identified more as working class Americans than they do as Hispanic Americans, which is really the heart of the American dream. I think we take that same social message, that is job creation and pro-family. You don't have to apologize for being pro-family. You have to certainly understand the culture you live in and speak to it. But I think that we need to get back in many cases to our roots, but also remembering that the working class American, the forgotten man and woman, is still out there, and they're still looking for a voice. And Donald Trump was that voice, and I think we can continue to give that voice, but at the same time recognizing that the world's a shrinking place, and we also have to remind people that all of this that we cherish so much depends on a really strong military, and we have to remind people that we didn't used to have a near-peer adversary in China, but now we do. The Soviet Union broke up, but in many respects is coming back in the person of Vladimir Putin.
Senator, there's a question of giving a voice to the working class Americans, and there's also a question of creating the right economic backdrop for them. I believe a coalition of Republicans are about to counter-propose a $1 trillion plan to President Biden's infrastructure spending initiative. Do you have a sense of what's in it and whether you would sign on to this?
Sure, great question. I do have some sense of it, and
Okay, guys.
In fact, I think
position closed on euro, as you can see. Let me show you our position that we we purchased here a few days ago, last week even, yes, at 122.097. So we close position right now at 122.197. So all of you guys who followed my trade and who decided to purchase it, you've done it. You close position. In our case, we have 10 pips. 1 pip gives us 100 pounds, 10 pips, totaling 1,000 pounds. In your case, it's all about how much broker pays you per pip. Okay? Stay well, stay safe, and let's move on. Let's not concentrate only on one winning. Okay? I'll speak to you later, guys, and stay safe.
Part of the federal taxpayer. So I think you can get to $1 trillion by having some simple permitting and regulatory reforms that maintain the integrity of our environmental excellence, while at the same time unleashing the private sector investment. And here's the other thing, you guys, by putting more money and investment in American energy rather than Iranian and Russian energy, you actually help the climate and the environment, because we produce even fossil fuels with a much lower carbon footprint than other countries do.
Senator, what's the distinction between going even bigger in the proposal that you're talking about and the $1.7 trillion plan that President Biden is talking about, especially when you talk about high inflation rates? Why is the plan that you're proposing not going to ignite inflation, whereas the other one you say will?
Yeah, because ours doesn't involve more federal spending or more borrowing or, more printing of money. To the degree we can repurpose the 750 billion to $1 trillion that's already been appropriated but won't be spent by the end of this fiscal year. That's not new taxes. That's not new printing. So that actually puts that liquidity, if you will, to work in the marketplace in a way that creates jobs and creates an asset that at the end has a value and has, the movement of goods and services throughout the country. So I actually think that we do just the opposite by going bigger, as long as we're not printing new money or borrowing more money.
Senator, the only reason we had you on is Lisa Abramowitz puts down the German skillet at Kroll's Diner like nobody in Fargo, North Dakota. We're not going to do this in February, but we need a surveillance road trip so Lisa can remember her years in Fargo, North Dakota. I'm thinking pheasant hunting in, maybe in the autumn, September, October. Can we get that done?
Yeah, for sure.
We can absolutely get that done. Lisa probably knows the perfect guide, and if she doesn't, I'll find the best land you can go hunting on. So Kroll's Kitchen, truly one of the great institutions in North Dakota, and they know how to make homemade German food.
They do. Senator, thank you so much for joining us today. He is
Always
a senator from North Dakota, Kevin Cramer, here on the day of the death of the senator from Virginia. Truly, he was a senator from Virginia, John Warner. Lisa, it's just great to talk to these senators and politicians around the country.
We'll host surveillance from the Yemkomst Center in Fargo, North Dakota, and you will be underneath the Viking ship.
You're going to take me there in January. I can see it now.
Oh, you better believe it. You're going to enjoy all of the weather proofing that you'll need to do.
It'll be an eventful day here on Bloomberg. We drive forward the conversation. Amazon, MGM clearly front and center with breaking news, a drama in Washington of bankers in attendance. And then the markets, again, equities up, and we're watching yields, I should point out, 1.5655 this day of the 125th anniversary of the Dow Jones Industrial Average. The Dow, 34,349. That's the last time you're going to hear it on TV for an hour.
Yeah, that's true.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our audience worldwide, good morning, good morning. Equity futures this morning, 41.95 on the S&P 500. Positive going into the opening bow with 30 minutes to go. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue. The market shrugging as the Fed talking about tapering.
Nothing's moving.
Bonds are flat.
Range bound.
Yields have kind of moved sideways for the last few weeks.
Range bound. A month and a half of consolidation, trading sideways.
More range bound.
In the meantime, the inflation narrative is still there.
New set of fears are emerging.
For the first time,
the Fed is likely to start to shift their policy stance.
They are talking about tapering.
Are we getting too hot?
Everybody's going to remain focused on inflation.
The thinking about tapering.
You will see this tug of war and this tension between risk on, risk off.
That tug of war continues. Joining me now is Ashok Bhatia of Neuberger Berman and George Bory of Wells Fargo. George, let's start with the bond market. 2s, 10s, 30s, your 10-year 156, your 30-year 225 rather, on a 10-year at 156. George, we're having a real conversation now, a sneak peek of maybe talking about tapering at some point, and yields are lower, not higher. Why, George?
Yeah, hi, good morning, John. Thanks for having me on the show. Yeah, we've been in a consolidation phase for the last 2 months, and we think things are about ready to get a little bit more spicy. We've kind of gone through this period where the market's had an opportunity to look at some of the data, to digest some of the trends, and to be quite frank, we're getting a lot of conflicting signals. As we know, the data is very, very noisy, and so it's very hard to take a strong stand one way or another for a directional bet. But next week and in the following week, we're going to start to see data that should start to confirm a recovering economy, inflation that's continuing to rise, and sort of this post-COVID world where people are getting back to normal. And in doing so, they are actually pushing up economic activity pretty significantly. So although we've kind of gone through this little transition period, the next 2 weeks, whether it's non-farm payroll next Friday, the inflation data just a few days later, and then finally with the Fed meeting, the narrative is going to start to change. We think yields will start to move higher, and we do think that the underlying trend of recovery, which has really just begun, is going to start to gain momentum as we head into the summer.
Ashok, what's your take on this? We're about 20 basis points south of the highs of the year.
Yeah, I think what George said, there's a lot of things there we agree with. I think there's two issues that are coming that maybe just to add on. One is as you talked about, tapering and tapering discussions, they're only heating up. The Fed's buying $120 billion worth of bonds a month. These were liquidity support programs that I think it's really hard to argue the markets need that still. So the unwind or the reduction of Fed purchases, that's not just a story for the next month or two, but we're going to be sitting with that all year. On the conflicting side is the labor market in the U.S. Our view is that the payroll number last month was not, perhaps as much of an outlier as the market thinks, that there are some serious issues about labor supply coming back. And that argues for the recovery being a little more drawn out than maybe the market's expecting. So add those two things up, we think we're going to sit in this range, call it, 175 to 145 for a few more months at least.
August, September, and that's what you're waiting for, George, to validate this story of moving towards 2% on a 10-year. What's special about those 2 months?
I think by the time we get into August, and certainly as we transition into September, the trend is going to be clear. We're going to see sort of what the market is looking for, and particularly as my colleague just mentioned, the inflation data is very, very important here. The bond market is sort of hanging on inflation, and there's a big question mark about, like the Fed has said, is this going to be transitional, or is it something more longer and drawn out? Our expectation is that it will be a bit more drawn out than perhaps, sort of what the Fed is leading us to. If we've get sort of a high print on inflation in June, again in July, perhaps another one in August, then the market's going to realize that, in fact, pricing power has come back. Inflation has moved higher. It may not be sort of spiraling out of control, but the momentum behind inflation should be pretty strong. The other, as we as well as many others are looking towards the Jackson Hole Symposium, it's when the Fed tends to try and anchor its forward-looking expectation, its bigger picture about the economy, about policy, about potential shifts. All of these things kind of crystallize, if you will. They come together towards the end of the summer and then really sets the stage for the last third of the year. And that's really where we think things are going to, kind of once again heat up a little bit.
Well, maybe later on in this summer we'll get a little bit of volatility. Right now, over the last few months, it's been a range-bound market. Your 10-year, the high 174 at the back end of March, the low 153.80 of April 22nd. For more on that, let's bring in Abby. Morning,
John,
Abby.
Good morning, John. Well, it really has been a range-bound market for yields since the end of February, as you were just mentioning. Let's call it between 145 and 175. Investors really not knowing how to make sense of inflation versus the Fed, which way will win, many calling for that 2%. It'll be interesting to see, though, what does perhaps break that range, and it could be down, although it could be up. Now, this could be the big reason why we also have stocks stuck in sideways. The S&P 500 over the last few weeks stuck between about 4,000 to 4,200, and the RSI for the S&P 500 showing that it's not overbought or oversold. Again, stuck in neutral. Investors really not knowing what to make of all of the mixed signals, really weighing, once again, inflation versus the Fed. What is winning, though, very clearly is value. Value over the last month is up about 2%. This as growth is down 2%. And it seems maybe, John, growth has peaked, or perhaps investors are, of course, anticipating that 2% or higher as perhaps, valuation concerns won't be weighing just as much, John.
Abby, thank you. Just quickly, George Bory, treasuries in a range. You just mentioned the dollar, not so much.
Yeah, no, the dollar's weaker, and that's the one, sort of major market where we've seen, actually a trend evolve. And our view is not so much that, sort of growth in the U.S. has stalled out. It's actually that growth outside the U.S. is starting to accelerate. You've seen some very nice data out of Europe, in particular in the U.K., even in Asia. And so this sort of whole notion of kind of the global recovery and sort of a rotation, if you will, is still very much in place. Now, if you look, stock markets are clearly in kind of holding in neutral, as are kind of bond markets in general. But the currency market, we think, is starting to kind of sniff out, if you will, kind of this global recovery trade that is now morphing beyond the U.S. And that stimulus that you've seen in other parts of the world is actually taking hold. So, there are a few signals that are getting clearer, and as we like to look at the foreign exchange market as a leading indicator, we think that is one that we think kind of could provide a little bit of guidance as we head into the summer.
Ashok, let's build on that. How important is it that we've got these differing reaction functions at central banks? We've seen Canada move a little bit earlier than anticipated. We've seen the Bank of England just reduce purchases month on month, the pace of them, not the overall package. Then New Zealand overnight making its move. The Federal Reserve seems to be behind the curve, so to speak, compared, relatively speaking, to the rest of the world.
Yeah, I think there's two messages there. I think, first, some of those smaller banks are hints about where the Fed, the ECB, and the PBOC are likely headed over the next couple months. But the second is, the mandates are a little different. And, I think one thing that's developing is the central banks, at least in the Fed and ECB, are starting to interpret their mandates a little bit more expansively than we're used to. I mean, the ECB talking about climate change risks, the Fed talking more and more about the breadth of the recovery. Certainly, they're not inconsistent with their mandates, but they're new things. And I think those argue for, a little bit more extended dovishness from the big central banks. And ultimately, the Fed, ECB, PBOC, those three in the liquidity conditions they provide, they're likely to be the biggest driver of global markets. So I think it's a hint, but I think those three are going to end up being more quasi-permanently dovish than perhaps some of the other banks.
Just briefly, let's turn to the breaking news in the last 40 minutes or so. Amazon agreeing to buy MGM Studios for $8.45 billion. This is the quote in the press release. The real financial value behind this deal is the treasure trove of IP and the deep catalog that we plan to reimagine and develop together with MGM's talented team. That's the PR speak. Here's the price action for Amazon this morning, positive by about 0.5%. That's the equity side of the story. George Bory, I just want to talk about the debt side. Here's a company that came to market in the last month and issued debt as if it was a sovereign. How important is it just to look at where these yields are priced in investment grade for companies like Amazon?
And you make a great point. Liquidity is got multiple dimensions, whether it's trading, but more importantly, it's cash in the hands of companies and individuals. M&A is a big story this year. It's going to continue to be a big story as companies, both here in the U.S. and around the world, kind of use that relatively cheap form of funding. It's a great time to be a borrower. As you point out, Amazon locking in exceptionally attractive borrowing costs, and then they turn around and they use the money, and that's something that we should expect. Bond investors need to be kind of attuned to that. We need to watch for that. The credit market is telling you that things are generally okay. Spreads are very tight, or they're tight by historical standards, pretty close to cycle tights for the most part. But as companies become a little bit more kind of aggressive and use that money, we need to be very careful about, sort of event risk, if you will, the risk that a company uses that extra cash to meaningfully leverage up, and that could ultimately hurt creditors. Now, in this particular case, it doesn't appear to be so. This seems to be a sensible transaction. However, we do need to keep a close eye out on that. That being said, we are getting a little bit more cautious on our credit book as we kind of want to move a little bit up in quality as some of those kind of looser, more aggressive sort of strategies, if you will, get implemented.
Just a final word on that, Ashok, on that dynamic that George Bory just walked us through.
Yeah, I think the trend, and it's similar to what we saw with AT&T Discovery last week or the week before. That's actually a deleveraging trend transaction for bondholders. So the narrative that corporations are just going to borrow and increase leverage. For a lot of the investment grade corporate world, they're at the right leverage levels to remain, say, a triple B credit. There may be some single A credits that want to migrate down to triple B with leverage. But I suspect that more transactions we see are going to look like this transaction or AT&T Discovery, which kind of maybe non-intuitively can be decent for bondholders because the use of cash is going to pay down some debt.
Ashok Bhatia and George Bory sticking with us. Your equity market this morning, positive about 0.2% on the S&P. At the market desk with your movers, here's Abby.
John, here's something. The NASDAQ 100 futures right now heading to their third up day in a row. The first time we've seen that since April 10th. So the tech bulls are out. And let's pick back up on Amazon, as you all were just talking about, up 0.5% on that deal to buy MGM for $8.45 billion. And this really underscores the importance of content for this streaming space, the race to content, Amazon buying MGM, really underlining that idea. Big tech overall, not big gains, but again, 3 up days in a row. We have not seen that since the beginning of April. This, of course, after into today, yields down 4 days in a row, the 10-year yield losing about 10 bips over that time period, taking away valuation concerns. Today, flat, just right for big tech, and it's also just right for the reopening trade. We have the cruise operators up once again, high hopes that these operators, these boats will be sailing soon, and of course, vaccine optimism, a big piece of it. So you have tech and the reopening trade working on the day, John.
Abby, thank you. Coming up on the program, Senate Republicans preparing an infrastructure counterproposal worth roughly $1 trillion. That conversation coming up next with Neuberger Berman's Ashok Bhatia and George Bory of Wells Fargo. From New York, with 17 minutes to go until the opening bell, futures at 41.94 on the S&P, up around about 8 or 9 points. We advanced 0.2%. This is Bloomberg.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This could be a very good summer for the world, where the way of avoiding taxes and changing the place where you pay the tax, and where the way of a tax race to the bottom is stopped.
G7 finance ministers honing in on a Biden-backed agreement that could change the global tax landscape for the largest corporations. This amid an ongoing fiscal debate in D.C. as Senate Minority Leader Chuck Schumer, or Senate Majority Leader Chuck Schumer, rather, preparing to move forward with or without Republican support on an infrastructure bill, saying the following: "Our goal is to deal with a big, bold plan in July. We hope to move forward with Republicans, but we're not going to let them say no and stand in our way." The GOP striking a more optimistic tone, preparing to unveil a new counteroffer as soon as Thursday that could be worth almost $1 trillion. Let's head down to D.C. and catch up with Emily Wilkins for more. Good morning, Emily.
Morning, Jonathan.
What is the latest?
So I think you've really hit on sort of one of the big things that we're seeing right now, which is House Republicans, or rather Senate Republicans, coming back with a counteroffer to the White House, after President Biden unveiled his latest counteroffer, that $1.7 trillion infrastructure package. We kind of saw Senate Republicans give it the cold shoulder. There wasn't a lot of enthusiasm, but now both sides are saying that they are going to continue negotiations. We're going to see this new proposal coming from the Senate Republicans. And yesterday we heard White House Press Secretary Jen Psaki say that the White House is eager to hear what is proposed. You're also seeing a bit of a Plan B form in the background. A number of senators, a bipartisan group, including Senator Mitt Romney and Democratic Senator Joe Manchin, have said that they're also starting to work on a proposal. This would be something that is focused on, say, traditional infrastructure, roads, highways, bridges, some broadband, but not a lot of the electric cars or any sort of those climate change proposals that President Biden included. There's still a ways to go with this potential Plan B. It's not clear exactly how it would be paid for at this point, but it does show that there's a backup already in the works should the current negotiations between the White House and Senate Republicans fail.
Emily, thank you. Still with us, Neuberger Berman's Ashok Bhatia and George Bory of Wells Fargo. George, I found myself asking this question a million times. How you come up with the base case for what to expect down in D.C. on the fiscal front for the year ahead? How do you?
Yeah, I mean, I think that's a great question, John. I mean, we talked about stalled markets, and it's no great surprise that as soon as Washington started talking about its next stimulus plan and we saw alternate views come out, the markets have really stalled out, over that time period. And the reality is one of the biggest drivers, well, the biggest driver of demand over the past year or so has been fiscal stimulus. And so that is one of the key crux. That's sort of the pivot, if you will. We think of sort of where the next kind of leg of economic recovery is ultimately going to come from. We've got the Fed kind of dialing back its support, and that the federal government wants to lean in with its ongoing support, but it's unclear as to whether or not they're ultimately going to get there. It's encouraging that you see the GOP coming in with its own proposal, which is still sizable, and the willingness and desire to invest in the infrastructure of the U.S. seems like we're going to get a deal. But it's really about the size of the deal and ultimately how that money is distributed across the different constituencies. Now, that could either slow things down, which it probably will, but the White House and the Democrats have, there is an urgency here. There is a desire to get a deal done. And so we think both sides get to the table. It's probably going to be somewhere between a trillion and $2 trillion, probably closer to $1 trillion, because the GOP does have some leverage that they're able to exert on this process. So we're encouraged. We think there will be a deal, but we don't think it's going to be quite as big or as grand as what the White House is hoping.
Ashok, do you think this is part of the story as to why treasuries have stalled? Because this conversation has stalled relative to where it was at the beginning of the year.
I think it's partly. I do think the market expects with one party having control of government and midterm elections only a year and a half away, that something as George indicated, something's going to get done. The size $1 trillion, $2 trillion is likely we're going to get a deal. I do think rates have been a little bit more. I think the bigger driver has been less the change in the infrastructure bill and a little bit more the conversations about tapering and whether the Fed's going to take support away and also the disappointing labor market and what that potentially means for the durability of this recovery. So I think those have been bigger drivers for the range-bound market.
To wrap things up, guys, I do wonder where you think the pain trade is at the moment. I've asked this question a couple of times over the last week or so. What would exert the maximum amount of pain on the most amount of people? Would that be higher or lower yields from here, Ashok, on a 10-year treasury?
I think it's lower yields. I think it's an environment where, we've talked a lot about transitory inflation. And look, this is not what we're expecting, but to answer your question about the pain trade, it's that inflation has already peaked. We start to see inflation numbers start to fall, and the 10-year breaks that, 150, 145 level.
What about you, George?
Yeah, I agree. It seems that the market is biased. It's set up for slightly higher yields at the very least, and then in some cases, materially higher yields. At the same time, long-term investors, savers are also sort of hoping for higher yields. There's a desire to generate income in a lot of different investment portfolios, both here in the U.S. and around the world. So, lower yields from here would exert a significant amount of pain. It would also mean that likely that either policy's not working or that the economic recovery is kind of sputtering out. And so there's a lot of hope that what we've done to date is going to prove to be pretty robust and ultimately help create sustainable both growth and to a certain extent inflation. If that fails, well, then the market's going to head lower and perhaps meaningfully lower. But again, that's not our central case, but that would be the biggest risk.
George Bory, always good to catch up, sir. Thank you.
Thank
and
you.
to Ashok Bhatia, thank you, sir. Thank you very much for your time this morning. Coming up, the morning calls and later, tech stocks making up lost ground after lagging behind cyclicals all month long. That conversation still ahead with BlackRock's Tony DeSpirito and Dan Suzuki of RB Advisors. As we count you down to the cash open, 8 minutes away, 41.93 on the S&P 500, up 8 points. We advance around about 0.2%. It is a no-drama Wednesday morning so far, at least. Good morning to you all. This is Bloomberg.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vowels in a digital future.
Come on, John, I just think it works.
It works. For Bruce.
We've beaten this to death.
Watch weekday mornings on Bloomberg Television.
We're about 6 minutes away from the opening bell in New York City this morning. Good morning to you all. The price action shaping up as follows on the S&P, up about 0.2%. On the Nasdaq, advancing about 36 points or so, up 0.25%. This market's fascinating right now. For all the hand-holding from the Federal Reserve, the concern about tapering, that tug of war, we have a conversation about having a conversation about it, and this happens. Not a lot. Switch up the board and get to the bond market. Your 10-year Treasury still comfortably below 160. Right now, 156.21. The point about stability is an important one. Stability not seen, though, in the FX market recently. Just a little bit of dollar weakness coming through. This morning, the euro weaker. Euro dollar at 122.23 and down 0.2%. As ECB official Fabio Panetta starts pushing back against the prospect of tapering or pulling back on accommodation anytime soon. This is the price action. Here are your morning calls. A look at some of the analyst recommendations this morning. We'll begin first up with B. Riley, downgrading AMC Entertainment to neutral, a $16 price target. The analyst saying the cut was solely due to the stock's valuation. That stock is up by more than 10% in early trading. And your second call from JP Morgan, upgrading Urban Outfitters to neutral with a $38 price target. The analyst forecasting strengthening demand for office attire. That stock's flying too, up by more than 11% going into the cash open. And your third and final call, it comes from KeyBank, raising its UPS price target up to $235. The analyst expecting the company to provide a credible path to earnings growth as its June 9th Investor Day. We're up about 1/3% there in early trading at 212.19. Coming up, Big Tech making up lost ground after leading the declines for most of the month. That conversation still ahead with BlackRock's Tony DeSpirito and Dan Suzuki of RB Advisors as we count you down to the cash open in New York this Wednesday morning. Good morning. Equity futures doing okay, up 8 points. We advanced 0.2% on the S&P 500, 41.93. This is Bloomberg.